Hello everyone, welcome to EduTap and welcome to today's session. So good evening to everyone and welcome to the session. Welcome to the marathon session for the RBI Grade B 2024. The phase 1 of the RBI Grade B is quite near now and I hope you all are preparing really well for the examination, and we are conducting these marathon sessions so that we can boost your level of preparation. And today I am going to take your marathon session for your RBI notifications and your finance current affairs. So we are going to have the coverage of the RBI notifications, that is your RBI website I can say, and the finance current affairs. Okay. So I hope you all are ready, and give me a thumbs up if I am clearly audible, if I am clearly visible. Just give me a thumbs up if everything is fine. Am I clearly audible? Am I clearly visible? So just give me a thumbs up. And today we are going to discuss various questions and the various topics under the RBI notifications and the finance current affairs. And before starting with the questions, do subscribe to the YouTube channel of EduTap and do join our Telegram channel. In the Telegram channel, you will be getting the PDF of today's session. So the PDF of today's session you will be getting in the Telegram channel, and the link for the Telegram channel will be provided in the description box below. Okay. So we are going to start with the first question, and I hope I am clearly audible. All fine? Yes, all good. Okay, so I have a number of questions. I am aiming to finish this session within 2.5 hours. Let's see how lengthy it might be. Okay, so the aim is to finish this in like 2.5 hours. That is by 9:30 most probably. But let's see. Okay, so this is the first question. Let's see how many of you are able to answer this question. So since the transfer of regulation, so what has happened that the housing finance companies, they are transferred under the regulation of the Reserve Bank of India. So RBI regulates the housing finance companies. Okay, so RBI regulates the HFCs. So recently it has been said that the guidelines for the HFCs and the guidelines for the NBFCs that is regulated by the RBI will be normalized or will be harmonized. Okay, so which of the following ideas is correct regarding the HFCs? Which of the following guidelines have been proposed by the RBI for the HFCs? So A, everyone is saying A. Let's see how many of you are correct. So currently in terms of section 29B of the NHB Act 1987, the deposit taking HFCs, that is the HFC, the housing finance companies that are taking the deposit, they are required to maintain 13% liquid assets against the public deposits held by them. So this is correct. It has been decided that all the deposit taking HFCs shall maintain on an ongoing basis the liquid assets to the extent of 15% of the public deposits held by them. So this is correct in a phased manner with 12% of the government securities. So this is wrong. Not 12%, but it is actually 10% of the unencumbered approved securities. So the second statement is actually wrong. In terms of section 29A, the NHB 1987, the Act of 1987 of National Housing Bank, the investment loans exposures to subsidiaries companies in the same group and other HFCs in excess of 10% has to be deducted of the 10% of own fund is reduced from the own fund to come at the net owned fund. Okay, so here actually the answer is 2 and 3. The incorrect statements are 2 and 3. Got it? Screen is getting cut. Okay. Just give me a second. Okay. Okay, I think it will be fine now. So just tell me, is it fine now? Okay. So currently in terms of section, the first statement is correct that currently the deposit taking HFCs are required to maintain 13% of liquid assets against the public deposits. Okay. So the answer is 2 and 3 because the second statement is wrong. The third statement is wrong. Yes. So second statement is wrong because it should be 10% here, and the third statement is wrong because it should be 10% here. So first of all, the Reserve Bank of India has said that in 2019, the regulation of housing finance companies were transferred from the NHBs to the NBFCs. Okay, so to the RBI. So RBI started regulating the housing finance companies. So the transfer of regulation of HFCs from NHB to RBI was in 2019, and since then the Reserve Bank of India is bringing the regulations for the HFCs. So now it has been said that there are going to be more harmonization or more similarities between the guidelines of HFCs and NBFCs, and for that there are the changes that has been brought. So currently the total liquid assets that the housing finance companies have to maintain against the public deposit is 13%, but it has been said that this has to be increased to 15% of the public deposits, and out of this 10% should be in the form of approved security. So I hope this is correct. So investment through alternative investment funds for calculation of net owned fund. So when we are calculating the net owned fund, so it has been said very clearly. Just a second. Okay, just give me a second. Okay. Okay. So now it has been said. So when we are calculating the net owned fund, so it has been clearly said, that when we are calculating the net owned fund, so here the subsidiaries and the companies, like we have to deduct the investment. The housing finance companies, they are doing the investment in the subsidiaries of the housing finance companies, in the companies of the same group. So in this case, that whatever investment that is happening in the subsidiaries in the companies of the same group, if that is in excess of 10% of owned fund, then whatever is in excess, that has to be deducted from the owned fund to calculate the net owned fund. Okay, so the investment that is happening in subsidiaries or the companies of the same group, so if it is in excess of 10%, so whatever is in excess of 10%, that investment has to be deducted from owned fund to get to the net owned fund. So this is correct, and it has been said that in this context, while arriving at net owned fund, investment made by HFC directly or indirectly, for example, through an alternative investment fund, that HFC is investing in alternative investment fund, and through that it is investing in the companies of the same group. So then this shall be treated in the same manner, provided the funds in the AIF have come from the HFC to the extent of 50% or more. Okay, or this is the basic idea, that if the HFC is directly investing or indirectly investing, that has to be taken into account, and this is the guidelines for that. Okay. Now coming to the next question, try to answer this question. As per the review of regulatory framework for HFCs and harmonization of regulations applicable to HFCs and NBFCs, this has been said that the ceiling on quantum of public deposits held by deposit taking HFCs. So the ceiling, the maximum of the public deposits that can be taken by the housing finance companies, this was before 3 times of the net owned fund. Now it has been reduced to how much? Now it has been reduced to what? Yes, now it has been reduced to 1.5 times of the net owned fund. So I hope this is clear, that yes, before it was said that the ceiling, the maximum of the public deposits that can be taken by the deposit taking HFCs, that was 3 times of the net owned fund. Now it has been made 1.5 times of the net owned fund. So which HFCs can take the public deposits if they have the minimum investment grade credit rating of BBB minus from any of the SEBI registered credit rating agency. Okay, now try to answer this question. So now here, so HFCs are allowed to accept or renew the public deposits. HFCs can accept the public deposit, but HFCs, like it is a kind of NBFC. So NBFCs or the HFCs, they can only take the term deposits. They can only take the term deposits that is for a time period, right? So the HFCs are allowed to accept or renew the public deposits repayable after a period of 12 months or more, but not later than 120 months. So it was the criteria before, okay, that minimum period for the HFCs are taking the deposits for a minimum period of 60 months and for a maximum period of 120 months. But now it has been said that the RBI has decided that henceforth the public deposits accepted or renewed by the HFC shall be for a minimum period of 12 months and minimum period of 12 months and maximum period of 60 months. So I hope this is clear that the HFCs before they were able to take the deposits for a minimum period of 12 months and maximum period of 120 months. Now it has been said that now RBI has said that the HFC will take the deposits for a minimum period of 12 months and the maximum period of 60 months as per the other NBFCs also. Okay, so this is the minimum period of 12 months and the not later than 120 months. This was the criteria before. Now it is that minimum period of 12 months and the maximum period of 60 months. Okay, so 120 and 60, so the C is the right answer. Okay, so here you can see that before it was 12 months, minimum period of 12 months, maximum period of 120 months. Now it is minimum period of 12 months and maximum of 16 months. Okay, so participation in currency futures, participation in currency options, there are criteria that which NBFCs can participate in the future derivatives, which HFCs can participate in currency options. So that is the simple criteria that you can see. Now coming to the next question. As per the review of risk weights for housing finance companies, the risk weight of fund-based and non-fund-based exposures to commercial real estate resident building. So HFCs, for the HFCs, there is the risk weight. The HFCs need to have the risk weight, right? Like they are giving loans. The housing finance companies, they are providing loan for the houses. So when they are providing the loans are the asset of the housing finance companies. So this asset, that is the loan that the housing finance company is providing, this has some risk attached. This has some risk weight. So risk weight of asset, like asset have some risk attached. Some loans have more risk, some loans have less risk. So the review of the risk weight has happened for the housing finance companies, and it has been said that the fund based and non-fund based exposures of commercial real estate residential building which are classified as standard will have the risk weight of how much percentage, and if the asset is classified as, like it is not classified as standard, so what will be the risk weight? So yes, 75%, very good, and 100%. So simply the commercial real estate residential building will have the risk weight of 75% if they are classified as standard. If they are classified as non-standard, so the risk weight will be 100%. Okay, so this is the risk that is attached. Okay, so risk weight for the housing finance company, it has been said that the risk weight, see what happens, that there are undisbursed amount. So it has been promised by the housing finance company. The housing finance company has promised that this much of loan will be given to this XYZ entity. But like this is the promise, commitment that has happened. But the disbursal of the loan will happen after 1 month or after, let's say 2 days, after 3 days. So the RBI is saying that even if the commitment has been made, even if you have the undisbursed amount that has been committed, so this undisbursed amount should also have the risk weight, because you have committed this money, you have promised this money. So here also there should be some risk weight that should be taken care of in order to address a potential anomaly in computation of risk weight for undisbursed amount of housing loans. So for the undisbursed amount of the housing loan, there should be some risk weight that should be taken into account, and the risk weight should be multiplied with the credit that is promised or that is committed. So this is the risk weight asset. So for calculating the risk weight asset, you have to multiply the risk weight with the asset, and the undisbursed amount is also the loan that you have committed. So take the risk weight for this committed loan also. Okay, next is risk weight for commercial real estate residential building. So for commercial real estate residential building, the risk weight is 75% if the commercial real estate residential building is under the standard category. If it is under the non-standard category, then the risk weight is increased to 100%. percentage. So I hope this is clear. Now coming to the next question, try to answer this question. And if there is any confusion, you can ask. NHB is the supervisor of the housing finance companies, and the RBI is the regulator, is making the regulations. Okay. Okay, so we are going to cover 3 months of the RBI notifications, RBI press releases, and 3 months of your finance current affairs. Okay, so there will be half weightage, half questions are from your RBI notifications and half questions are from your finance current affairs. Okay. So real GDP growth, as per the Monetary Policy Committee, the real GDP growth for 2024-25 is projected at 7.2%. Core CPI, core, that is the CPI, excluding food and fuel inflation, is at 3.1%. Assuming a normal monsoon, the CPI inflation for 2024-25 is projected at 4.5%. So CPI inflation for 2024-25 is projected at 4.5%. It was also informed that India's foreign exchange reserves reached a historical high of $675 billion as of August 2024. So first, second and fourth statements are correct, and that's why B is the answer here. The third statement was wrong. Okay. So here the B is the answer. So all of this data, the highlights are here, that the repo rate is kept at 6.5%. So if repo rate is at 6.5%, the SDF is at 6.25% and your MSF is at 6.75%. Okay, so this is the basic idea. So this is the basic idea, and your GDP growth forecast is 7.2%. Retail inflation, CPI inflation forecast is 4.5% for financial year 2024-25. And the foreign exchange reserves were highest at $675 billion. Now try to answer this question. Okay, the RBI notifications of 3 months as well as the finance current affairs of 3 months are going to take at least 3 hours. If I take from January to August, you can understand that it will take me 6 hours or 7 hours to complete that. Okay, 2.5 hours, Aditya. That is what I am assuming. 2.5 hours to 3 hours. Try to answer this question. 3 months. 3 months we will be covering. 3 months of RBI notifications and 3 months of finance current affairs. Okay. So RBI has observed that some of the P2P platforms have adopted certain practices which are violative of the NBFC peer-to-peer lending platform. So NBFC peer-to-peer lending platform, it is a platform that is bringing together the lenders that have excess money and the borrowers that have less money. Okay, so let's say that you have some 5-10 lakh extra rupees that you want to lend, and someone wants to borrow, let's say 5 lakh rupees, 6 lakh rupees and such. So peer-to-peer lending platform only has the task of providing a platform where the lenders can come and the borrowers can come and they can interact with each other, or they can lend or borrow from each other. So peer-to-peer lending platform, it is just providing a platform. So it has been said there are some new norms or some modifications that have happened, the clarification that has happened by the RBI. So the aggregate exposure of a lender to all the borrowers at any point of time across all the P2P platforms shall be subject to a maximum of rupees 50 lakh rupees, provided that the amount lent by the lenders on the P2P platform is consistent with their net worth. In case the amount lent by a lender is more than 10 lakh rupees, not 20 but 10 lakh rupees across all the P2P platforms, the lender has to provide a certificate from its chartered accountant showing that its net worth is 50 lakh rupees. That means if a lender is lending more than 10 lakh rupees, the lender has to show that its net worth is at least minimum of 50 lakh rupees. Fund transfer between the participants on the peer-to-peer lending platform. So the fund transfer is happening through the escrow account. That is the escrow account that is operated by a third party, that is your bank promoted trustee. Okay, so here the second and third statements are actually wrong, because here it should be 10 lakh And here it should not be peer-to-peer lending platform, but bank promoted trustee should provide the escrow accounts. Here only the lender norms have been given. So second and third, so this is correct. One is the first statement is only correct. So D is the answer here. Okay. So these are the norms that have been provided, that the peer-to-peer lending platform is not a lending like peer-to-peer platform. The NBFC is just providing a platform. It cannot take the credit risk. It cannot assume any kind of credit risk directly or indirectly. And the NBFC peer-to-peer shall not cross-sell any product other than the loan-specific insurance products, and the loan-specific insurance products should also not have the credit enhancement or credit guarantee tools. So this is what has been said. Okay. Next is that the aggregate exposure of a lender in all the P2P platforms should be less than or should be at the maximum of 50 lakhs only. And one one lender across all the P2P platforms, if it is having a more than 10 lakh of the exposure, then it has to show a certificate that my net worth is at least 50 lakh rupees. Okay. So this is the idea. Okay. And escrow accounts are required. One is the lender escrow account, where the lender is sending the money to the lender escrow account. Then there is a borrower, from the borrower, the money will go to the borrower escrow account. Okay. So lender will send its money to lender escrow account. That money will be transferred to the borrowers, and borrower will repay through the borrower escrow account. So borrower will make the repayments in the borrower escrow account, and through the borrower escrow account, the money will be given to the lender. So borrower and lender cannot send directly in their own accounts. The lender has to send the money in lender escrow account, borrower has to send the money in borrower escrow account, and then the transactions will be done. Okay. So this escrow accounts are handled by the bank promoted trusted. That is a third party that is handling these escrow accounts, so that the money laundering and such kind of things should not happen. And as soon as the lender escrow account or borrower escrow account has received the money, the transaction should complete within T+1 day. Okay. So these are some guidelines. Now try to answer this question. Chaitanya, if you have given the previous year RBI grade B, you must have seen that there were many of the statement based questions. Okay. Directly, it is like a cakewalk kind of question, from which cakewalk kind of RBI notification, from which a new number of questions can be formed. 50 lakh, 10 lakh, there are multiple data points. So this is important. Okay. And do see the previous year questions so that you have the idea that which kind of questions come. And there is not much distinction between the phase 1 questions and phase 2 questions now, especially in the RBI notifications. Okay. Try to answer this question now. Okay. The Reserve Bank has been conducting the survey of professional forecasters since September 2007. As per the 44 panelists, as per the survey of professional forecaster, the real GDP is expected to grow by 7% in 2024-25 and 6.7% in 2025-26. The real GVA growth is projected at 6.7% in 2024-25 and 6.4% in 2025-26. Annual headline inflation based on CPI is expected at 4.5% in both the financial year 2024-25 and 25-26. So this is correct. The first statement is wrong. The second statement is also wrong. You have to find the incorrect statement. So that is 1 and 2. So the answer here is A. The answer here is A. I hope this is clear. Okay. So remember, see, you have to remember the data that the last year a question came from the survey of professional forecaster. That question was directly about your real GDP. This is expected to grow at what percentage? So real GDP is expected to grow as per the forecasters. The real GDP is expected to grow at 7% in 2024-25, 6.7% in 2025-26. Now coming to your real gross value added growth. So this is from the product side, from the production side. So the real GVA growth is expected at 6.7% in 2024-25 and 6.4% in 2025-26. And for annual headline inflation, this is expected at 4.5% in both years 2024-25 and 25-26. Now try to answer this question. Yes, so for all the students, see from last year what has happened, that even in phase 1 there are statement based questions that are coming. Okay, so you have to be prepared at the top level. Titanium, there is like the new document you must have received. Shivam, for now just focus on, like, you can read the range, but for now focus on the data, important data points, okay, in the last time. So here, see, as per the survey of professional forecaster, as per the professional forecasters, the current account deficit is expected at 1% of the GDP during the 2024-25 and 1.1% of the GDP during 2025-26. So I hope this is clear that the answer here is D. So the merchandise export and import data are given, like what is the forecast as per the survey of professional forecaster. The current account deficit. Now current account, it includes the trade in goods, the trade in services, and the transfer payments. So current account deficit is expected at 1% in the 2024-25 and 1.1% of the GDP in 2025-26. So this is somewhat important here. Okay. Now the next question, try to answer this question, that as per the consumer, with the survey of professional forecasters, there is a consumer confidence survey that has also happened. So as per the consumer confidence survey, what is the data point now? Okay. So consumer confidence for the current period has declined for the second consecutive survey after the prolonged rising trend. So consumer confidence was increasing after the COVID situation, but recently from the last survey, what has happened, that the consumer confidence is declining, and the consumer confidence, as per the recent survey, the consumer confidence has come down from 97.1 to 93.9. Okay, yes, 93.9. So this is the data that as per the current situation index, the current situation index has come down from 97.1 to 93.9, and for the future, for the coming financial year, the future expectation index has come down from 124.8 to 120.7. Okay. So there was also the inflation expectation survey, but in the inflation expectation survey, there is nothing much that is provided. That only it is said that households median expectation or the average expectation of the households in regards to current inflation is at the 8.2%. Okay, so as per the household expectation, the inflation is going to be around 8.2%. Now try to answer this question. Sakalp, I will take your query at the end of the session. If it is not related to the topic, so I will take your queries at the end. Okay. So committee will submit its report by the end of November 2024, and this is under the chairmanship of Dr. Michael Debatra Patra. Correct. So there is an expert committee that has been formulated that is going to provide the benchmark the statistics regularly against the global standards. So it has been said that we have to improve our data collection, we have to improve our information generation, and we can do this when we have we are benchmarking our statistics, we are benchmarking our data collection against the global standards and against the best practices, as well as if the global standards are not present because we are collecting some spatial data. So we have to continuously improve the quality of the data. Okay, so this is the idea. So the committee, the expert committee that has been constituted for benchmarking the statistics against the global standards and for studying the quality of the data regularly, for that there is an expert committee that is headed by Dr. Michael Debatra Patra, and the committee will submit its report by the end of November 2024. Okay, now try to answer this question. So recently RBI in its statement on developmental, so statement on developmental and regulatory policy document is released recently. So the RBI has proposed to increase the UPI limit for tax payments from 1 lakh to 5 lakh. So if you know that for the per day limit is there in the UPI, for the normal transaction, if I'm sending the money to my brother or to my mother or to my friends, UPI daily transaction limit is 1 lakh rupees. But for the special occasions, like if I am transacting for the educational purposes or for the hospital and such, the limit is 5 lakh. For the IPO, the limit is 5 lakh. For the retail direct scheme, the limit is 5 lakh. And for the tax for the capital markets like the SIP, I want to have the collections, insurance premiums and such, foreign inward remittances, the limit is 2 lakh rupees. So A is the answer here. Okay. So for these transactions, the limit is 2 lakh. Okay. So 1 lakh limit is for the daily transactions, normal transactions. For the capital market, collections, insurance, foreign inward remittances, the limit is 2 lakh. For the education, hospital, IPO, retail direct scheme, the limit is 5 lakh. And it has been said for the tax payments also, for the tax liability, for the payment of tax and such, for that the limit is going to be increased from 1 lakh to 5 lakh, that up to 5 lakh of the tax payments you can make from the UPI. Okay. So the answer here is A. Yes. So here the limit is 2 lakh for these purposes, capital market, collections, insurance, forward inward remittances, the limit is 2 lakh. Always read the question very, very carefully and what the question is asking. Okay. Otherwise you will make the mistakes. So this is the different limits that I have just told you. So you can read it. So in the statement on developmental and regulatory policy, the Reserve Bank of India has also told that there is going to be the public repository for the digital lending app, so that the regulated entities such as the NBFCs, such as the banks, like let's say ICICI Bank is connected with digital lending apps, okay, that are lending through digitally, and that lending is linked with ICICI. So there are multiple digital lending app that is connected with ICICI. So the public repository will be based on data that is submitted by the regulated entities, by the NBFCs, by the banks, that is regulated by the RBI directly. They will be feeding the data in the repository, in the public repository, and this public repository will get updated so that the people are informed that which digital lending apps are good and which digital lending apps are actually authorized and connected with the particular bank. Okay, so this is the main point here. Then frequency of reporting of credit information, this we are going to discuss now. So try to answer this question. So now, the RBI has directed that the credit information companies and the credit institutions shall keep the credit information collected or maintained by them updated regularly on a fortnightly basis. Correct. Before it was happening usually on the monthly basis. Now it has been said that it should happen on the fortnightly basis. The fortnightly submission of credit information by the credit institutions to credit information companies shall be ensured within 5 calendar days. No, it shall be ensured. See, the credit institutions have to send the details to the credit information companies. So credit institutions means the banks, the NBFCs, they have to provide the information to the credit information companies within 7 calendar days. Okay, and the credit information companies have to start using that data within 5 calendar days now. So the first and the third statements are correct. The second one was wrong, and that's why the incorrect statement is 2 only. So E is the right answer here. Okay. So this is the whole idea, that now on the fortnightly basis, the credit institution should be providing the information to credit information companies, and that fortnightly data will be sent within 7 calendar days, and the credit information companies will ingest the data within 5 calendar days. Okay. So this is the idea, and the timelines are being met. This will be supervised by the Department of Supervision, and this guidelines have to be followed from January 1, 2025. If a bank is following the guidelines from beforehand, that is also good. Okay. Now coming to the next question, that is very important. So recently the Reserve Bank of India has released the guidelines or the framework of self-regulatory organization for the financial market. So as you know that the Reserve Bank of India is regulating the money market. The Reserve Bank of India regulates the interest rate market like the repo operations and such. The RBI is regulating the forex market. So Reserve Bank of India is also regulating the financial markets, some of the financial markets. So whichever financial markets the RBI is regulating, for those financial markets, the RBI has released the framework for the SRO for the financial markets. Now kindly tell me that the entities intending to function as a SRO of the financial market must have self-regulatory organization. If you want to become a self-regulatory organization in a financial market, this you must have a minimum net worth of INR 10 crore. Very good. INR 10 crore. Okay. So this is a fact that is quite different in the SRO framework of the financial market. This is different from the other. If you see the SRO for NBFCs, the SRO for NBFCs and the SRO for fintech, they have some different net worth requirement, while the SRO for financial market has a different net worth requirement, because financial markets are quite complicated. Okay. So it has been said that RBI also regulates many of the financial markets. So for the financial markets regulated by the RBI, there is a self-regulatory organization for the financial market that can be there. Okay. So applicant that wants to become the SRO in the financial market shall be a not-for-profit organization under the Section 8 of Companies Act of 2013, and the applicant must have a minimum net worth of INR 10 crore and should possess or have the ability to provide the infrastructure as a SRO. SRO is the self-regulatory organization that is going to provide the linkage between the Reserve Bank of India and the financial market intermediaries or the financial market entities. Okay. Now, no entity shall hold 10% or more of its shares of the SRO. Okay. So if an entity wants to become a SRO, no single entity or no entity acting in concert should have 10% or more of the shares in this entity that wants to become the SRO. So there are different norms. The characteristic of SRO is that the SRO should be having a sufficient authority. It should be signing the membership contracts that the financial market members that want to become the member of SRO, they should have a membership contract with the SRO. The members under the SRO in this framework means the members used in this framework refers to the market participants, authorized market infrastructure providers which accept the membership of SRO. So the financial market intermediaries or financial market entities can become the members of SRO, and you can read the further guidelines. Now coming to the next point. Kindly answer this question. Shivam, there is a different team that is making the RBI news tab. So they have told to me that a new document has been updated with the new guidelines that were left before. So you can mail or you can write it in the discussion forum and they will tell you that where it is provided. Okay. So now, Reserve Bank of India recently released the financial literacy ideathon with a particular topic, and the Reserve Bank of India had announced the financial literacy ideathon during the financial literacy week. So what was the theme of financial literacy week? It was make a right start, become financially smart. So the financial literacy week was conducted in your Feb to March, and during that financial literacy week the theme of the FLW was make a right start, become financially smart. And during that financial literacy week there was a ideathon that was conducted, and that ideathon was for postgraduate students on the topic money matters for young adults, rethinking outreach strategies. So on this topic the ideathon was conducted. Okay. Now coming to the next question, that there is a survey that has been conducted for the mutual funds and for the asset management companies, and as per the survey, which of the following statement is incorrect, that you have to tell me. The foreign liabilities of mutual fund companies increased by 46% during 2023-24. Anyone? B is you have to tell the incorrect statement. Read the statements very carefully and then try to answer me. Okay, very good. So foreign liabilities of mutual fund companies increased by 36% during 2023-24. The UAE, US, UK and Singapore were the top destination for mutual fund units held by non-residents, both in terms of face value as well as market value. Correct. So first one is wrong, second one is correct. The third one is wrong because the USA and Luxembourg accounted for nearly 85% of the overseas equity. Okay, so if the mutual fund are pooling in the money, so foreign investors are also investing in the mutual funds. So the foreign investors, they are investing in the mutual fund, so that is a liability of the mutual fund, because the mutual fund will have to return the money to the foreign institutions whenever they demand. Okay, so this is the liability of the mutual fund. Now the mutual fund are like they are pooling in the money and then they are investing the money in some assets. Okay, so that can be in the overseas, like in the foreign assets also, in the foreign equities also the mutual funds are investing. So the USA and Luxembourg accounted for nearly 85% of the investment that is done by the mutual fund in the overseas asset. 85% of that is in USA and Luxembourg. Okay, so first and third statements are wrong, because in the first statement it should be 36%, in the third statement it should be 85%. So 1 and 3 are wrong, incorrect, and that's why that is the answer. Okay, yes. So this is the data. Foreign liabilities of mutual fund companies have increased by 36% during this financial year, and the USA and Luxembourg, we are investing the most. The mutual funds of our country are investing the most in the USA and Luxembourg. UAE, USA, UK and Singapore, they are investing in the mutual funds of our country, and that's why mutual funds of our country have the highest liability to these four countries, or these four investors, that they are from these countries. So now asset management company. So for the asset management company, the foreign liabilities have increased, have nearly have increased by $3.4 billion, while the overseas asset of asset management company is $0.1 billion only. Residents of Japan, Canada and UK have done 83% of foreign direct investment in asset management companies. So asset management companies are managing the asset, are managing the mutual funds, the pooled money, and the asset management company, they have received the foreign direct investment mostly from the Japan, Canada and UK. Okay. Now try to answer this question. This is regarding your PCA framework, the prompt corrective action framework for the primary urban cooperative banks. So net non-performing advances ratio of greater than or equal to 6% but less than 9% falls under the category of risk threshold 1. Okay, so the urban cooperative banks have been brought under the PCA framework, under the prompt corrective action framework. That means if they are in the risk categories, as per the indicators, if they are in the risk categories, they will have to follow the higher supervisory norms. Okay, so the net non-performing advances ratio, if the NNPA is higher than 6%, like is equal to or greater than 6% or less than 9%, the UCB will come under the risk threshold 1. The PCA framework shall be applicable to all the UCBs, that is in the tier 2, tier 3, tier 4 categories, except the UCBs which are already under the highest of the guidelines, that is all inclusive directions. So all the UCBs that is under the tier 2, 3, 4, they will come under PCA framework. They can come under PCA framework other than the UCBs in the all inclusive directions. So except, okay, the hard coded limit of 25,000 that was present in the previous guidelines of the SAF. Now this has been removed for the tier 2, tier 3, tier 4 categories under the PCA framework. That is the idea. Okay, so yes, so here the correct statement you have to tell. So only second statement was correct, first and third is wrong. So E is the answer here, 2 only. So here you can see that these are the indicators. As per the indicators, there are the risk threshold, that if you are breaching the indicator, then you are coming into a risk threshold 1, 2, 3, less risky, more risky, most risky. Okay, so this is the idea. Now there was a hard-coded limit of 25,000 of restriction on capital expenditure by UCBs under SAF. So under the supervisory action framework, if you are in the risk threshold 1, there was a limit that was imposed on the capital expenditure that you can do, but that was up to 25,000 only. This was the limit. Now if you are under the risk threshold 1, under the PCA framework, the RBI will decide that what limit should be imposed on the entity. So different limits can be imposed. Okay, so revised framework of the PCA, prompt corrective action, the limit will depend upon the assessment, not a hard coded limit. There is no hard coded limit now. So before there was the SAF framework. Now the SAF framework has been substituted by the PCA framework. So PCA framework is applicable on tier 2, 3 and 4 UCBs. Tier 1 UCBs will still follow the SAF framework. Okay, tier 1 UCBs will still follow the SAF framework. Now try to answer this question that which of the following mandatory actions have to be followed by a UCB in the risk threshold 1? Thank you so much, Akash. Glad that you are able to understand whatever I'm teaching. So there are some under the risk threshold. If you are in the risk threshold 1, which mandatory actions you have to follow? And if you are in the in the risk threshold 2, if in the risk threshold 3, you have to follow different mandatory actions. So in the risk threshold 1, which actions you have to follow? The first one. So as per Nitya, C is the answer. So first, third and fourth. Okay, so yes, if you are in the risk threshold 1, the mandatory action you have to follow is that the bank to raise the capital either from the existing members or by the issuance of equity and other permissible capital instruments. Okay, restriction is there on the declaration or payment of dividend and donation. So there are restrictions on how much payments you can make, and there is appropriate restrictions on capital expenditure other than for technological upgradation. So there are restrictions on how much capital expenditure you can do. Okay, so this is correct. 1, third and fourth, these are the restrictions that have to be followed by the risk threshold 1. In the risk threshold 2, they have to follow all the mandatory actions as per the risk threshold 1, as well as there is also restriction on the branch expansion. So if you are in the risk threshold 2, you will have to follow first, third and fourth, as well as you will have to follow the second one also. So in the risk threshold 1, you have to follow 1, 3 and 4 only. In the risk threshold 2, you have to follow 1, 3, 4 and 2. In the risk threshold 3, you have to follow 1, 3, 4, 2, as well as the fifth one also, that there will be restrictions on your expansion of total size of deposits. So these are the risk threshold and they have to follow the mandatory actions. Okay. Yes. So if you want to exit the PCA, you will have to follow these guidelines. Okay, as per the 4 continuous quarterly financial statements of the previous 4 quarterly financial statements, you should not have breached any of the risk threshold, and it depends on the supervisory comfort of RBI also, that they want to, the RBI wants to take you out of the PCA or not. So this is the exit criteria. Now coming to the next question, kindly answer this question. So which of the following statement is incorrect regarding the digital payment index? Okay, so first of all, the Reserve Bank of India digital payments for March 2024 stands at 445.50 as against 418.77 for September 2023. The Reserve Bank of India has been publishing a composite Reserve Bank of India digital payment index since January 1, 2021. So this is correct. This one is wrong. The RBI DPI is published on RBI's website on semi-annual basis with a lag of 4 months. Correct. Payment performance has the highest weightage of 45%. Okay, so this is also wrong. So first and fourth are wrong, and that's why the answer is D. Yes, the answer is D here. Okay, so simply the RBI DPI, the value of the RBI DPI is 445.50, and this has been launched since January 1, 2021, and the base year that is followed for digital payment index is 2018. So 2018 is the base year that is used for the digital payment index. Okay, that shows you the penetration and the deepening of the digital payments in our country, and that has 5 broad parameters: payment enablers, payment infrastructure, payment infrastructure demand side, payment infrastructure supply side, payment performance and consumer centricity. Payment performance has the highest weightage. That is the idea. Now coming to the next question, that is regarding your financial inclusion index. So try to answer this question. So financial inclusion index, this is provided by the Reserve Bank of India, and the Reserve Bank of India is providing the financial inclusion index in consultation with the other stakeholders also, because we want to see the financial inclusion in terms of the banking, in terms of insurance, in terms of pension, in terms of post office services that you are taking. So we want to see the financial inclusion from all the parameters. So financial inclusion has increased in our country. First of all, this is a annual index that is released by the Reserve Bank of India. So value of index for March 2024 was 64.2. That was up from 60.1. The financial inclusion index comprises of 3 broad parameters, that is access, usage and quality. It is quality, okay, not quantity, it is quality. So the usage has the highest weightage of 45%, access has the weightage of 35%, quality has the weightage of 20%. The financial inclusion index has been constructed without any base year. 0 represents a complete financial exclusion and 100 indicates full financial inclusion. So this is correct. The index is responsive to 3 broad parameters that are comprising 97 indicators. So this is also correct. Okay. Only the B statement is wrong. Only the B statement is wrong. Okay. So this is about the financial inclusion index that we have discussed. Now coming to the next question, that for the urban cooperative banks, the small value loans. So there is the guideline that has been released by the RBI in regards to small value loans by the UCBs. So what is the minimum percentage of small value loans that have to be achieved by the UCBs by March 31st, 2025? So be very careful in answering this question. Yes, I will surely provide this PDF, and you will get this PDF tomorrow by 12 p.m. Tomorrow by afternoon, you will get this PDF, okay? Because the team will be uploading this PDF in the Telegram channel. Okay. I can see the confusion, and see, RBI has said that, so the answer is 40% first of all. The answer is 40%, not 50%, because it has been said very clearly by the Reserve Bank of India that by March 2025, the UCBs have to achieve the small value loans, that is 40%. Minimum percentage of small value loans that has to be achieved by the UCBs is 40% of total loans. By 2026, they have to achieve 50%. So here it has been very clearly written by 2025. So by 2025, they have to achieve, by 2025, the UCBs have to achieve the minimum percentage of small value loans, that is 40%. And by 2026, they have to achieve 50% of the small value loans. What is the meaning of small value loans? So small value loans means the loans that is up to the value of 25 lakh, loans of value not more than 25 lakh, or 0.2% of their tier 1 capital. So 0.2% of the tier 1 capital, whichever is higher. So let's say 0.2% of tier 1 capital is, let's say, 75 lakhs. So that is allowed. This will also be considered as the small value loan, because small value loan is the loan of value not more than 25 lakh or 0.2% of the tier 1 capital, whichever is higher, subject to a maximum of 1 crore. So small value loans are within the 1 crore limit. So those are the small value loans that have to be achieved of 40% by 2025 and 50% by 2026. Now coming to the next question, kindly try to answer this question. Try to answer this question, that the framework for the domestic money transfer, this was introduced in 2011, and there were the guidelines that were released for the domestic money transfer. Now there is a review that has happened for the domestic money transfer. So kindly try to answer this question. Okay, I think I'm hiding this is 25,000. Okay, Priyanka, if see, if tier 1 if the tier 1 UCBs are under the SAF, all the guidelines will be followed as per the SAF. Tier 2 to tier 4 UCBs can come under the PCA framework, so all the guidelines will be as per the PCA framework. Okay, so yes, so here, see, first of all, what happens, let's say you do not have a bank account, you are going to a bank and you want to send the money uh, to your mother who has a bank account. Okay, so that is, you do not have a bank account, you are going to a bank to transfer your money. Okay, so that is cash pay in. This is cash pay in. You are giving cash to the bank so that the bank can transfer the money to the bank account of your mother. Or let's say that you have a bank account and you want to transfer the money to your mother. Now she does not have a bank account, so from your bank account there is cash payout that is happening. Okay, so there is cash pay in when the money is transferred, like from the cash, I'm giving you cash and the money is transferred in the bank account, that is cash pay in. Okay, I'm paying in cash. Cash payout is I'm paying through my bank account, I'm giving the money through my bank account, that is being taken out in the form of cash. So it was said that there are some times when someone does not have a bank account that is receiving the money or that is sending the money. In that case, there is domestic money transfer framework. So the cash payout schemes, that means you have a bank account and you are sending the money from your bank account to someone who does not have a bank account. They are going to take the cash out. They are going to take the the money is not being sent to a bank account, the money is going in the cash form only. So the cash payout scheme ceiling on the value of transfer is 10,000 per transaction, correct, and subject to a cap of 25,000 per month, correct. Walk-in customer, that means you do not have a bank account, you are going to give cash to the bank and the bank will send this money to a bank account through NEFT. It can happen up to the limit of 50,000, and the banks are also permitted to allow the walk-in customers to transfer the funds to a bank account of a beneficiary. Like you are giving the cash that can be transferred to a bank account. The maximum amount per transaction is 5,000 and the monthly cap is 25,000. Okay, so the C statement, D statement is correct. Remitter bank, that is sending the money, shall include the remitter details as part of. So walk-in customer has come, so to send the money, so walk-in customer is, I am giving you cash and you have to send this cash to a bank account. So the people that are receiving the money, they should have all the information that okay, through NEFT this money has come through, like this money has been sent by Mr. Raj or Miss Rani or someone. So remitter bank, that is sending the cash, that is taking the cash and sending this money to the bank account. So remitter bank shall include remitter details as part of IMPS or NEFT transaction message, and the guidelines on card to card transfer are excluded from the purview of DMT framework, correct. So A is correct, B is correct, C is correct, D is correct, E is wrong because it should be 5,000, not 10,000. Okay, so here you can see cash payout schemes, cash is given and the bank account, money is given through bank account and cash is taken out. Okay, cash pay in, cash is given, that is transferred to a bank account. So there are the limits. The limit for cash payout is 10,000 per transaction, 25,000 per month. For cash pay in, 50,000 through the NEFT, but through the agents and such, the limit is 5,000 per transaction, 25,000 total limit. Okay, and it has been clearly said that the guidelines on card to card transfer are excluded from the purview of DMT framework. There are the remitter bank has to keep the record and such, so this has been mentioned here, that's it. Okay, okay, I will correct this question. Here it should be incorrect. Okay, so 21st question, I will be correcting this out in the PDF. Okay, other statements are absolutely correct. Now all the other statements are like A, B, C and D are correct. Only incorrect statement is E. Okay, so E is the answer. I will correct this, do not worry about it. Okay, thank you for like pointing this out. I will correct this in the PDF. Try to answer this question. Just give me a second. Okay. So I've written it down. I have to I will be changing 21st question. Okay. So now the existing LCR framework for banks in India has been reviewed in light of recent developments. So what has happened? See, I hope you know the LCR framework. This is the liquidity coverage ratio. See what happens that as per the global standards, it has been said that the bank should have the enough of the high quality liquid assets in the form of cash, in the form of government securities, in the form of other approved securities. The bank should have enough of the high quality liquid assets that the bank is able to handle the net outflows in the next 30 days. Okay, because in the next 30 days there are going to be the people that will be taking out their money. So there should be enough of the cash and government securities and the other liquid assets. The high quality liquid assets should be with the bank so that the bank can handle the net outflow in the next 30 days without any distress, without any problem. Now it has been said that because of the digital transactions that are happening more nowadays, like through UPI you can easily take out your money, NEFT, RTGS, IMPS, like you can take out your money very fast through net banking, through mobile banking. So the process of taking out the money, the net outflows has become very high and it is very easy to take out the money. So existing LCR framework for banks in India has been reviewed in light of the recent developments that has happened in the digital transactions. So banks shall assign an additional 5% of runoff factor for retail deposits. That means additional 5% of the runoff factor has to be provided to the retail deposits, that the retail deposits can go out by 5% more. So total for the stable retail deposits, the that are connected with the internet and mobile banking facilities, the runoff factor will become 10%, and for the unstable retail deposits that is usually connected with the current accounts, that is usually connected with your merchant accounts, so that will have the less stable deposits will have the runoff factor of 15% if they are connected with the internet and mobile banking. Okay, so additional runoff factor will be 5%. So I hope this is very much clear that this we have discussed in our previous session that I took the revision session of August. So in that I clearly informed you that the LCR framework has been reviewed, that the bank shall assign an additional 5% of runoff factor for the retail deposits. Unsecured wholesale funding that is provided by, let's say, big institutions, or let's say not very big institutions, they are the small business customers. So they are the business customers. Let's say EduTap is a small business customer, any other entity that is in the edtech or any other entity that is having a kirana store, so they are doing business, but they are small businesses. Okay, so small business customers that are non-financial, even if they are depositing, even if they are keeping the money with the banks, the bank should keep this money, wholesale funding, as unsecured wholesale funding, because the small businesses usually are in the requirement of the money and they do transactions a lot. Okay, level 1 HQLA is the high quality liquid asset in the form of cash, government securities and such, and that should be valued at an amount not greater than their current market value after you have adjusted the applicable haircuts, after you have adjusted the applicable deductions. In case a deposit is a non-callable fixed deposit that cannot, the fixed deposit that cannot be taken out before the maturity, but if that non-callable fixed deposit is contractually pledged as collateral to a bank to secure a credit, to take a loan, such deposit shall be treated as callable, because you can understand that as soon as, let's say, I am not able to repay the loan, so the non-callable fixed deposit that is the collateral, so that will be taken out. Okay, so that the non-callable fixed deposit, if it has become a collateral, it should be dealt as, or it should be treated as callable. Okay, this is the idea. Now try to answer this question. If there is any confusion, kindly ask me. Okay. See, I am trying to provide you the brief information about the news articles. Of course, I cannot take all the news articles in the complete length, because one news article will be 20-30 minutes long, and I have to go through 70 news articles or 60 news articles today. So I hope you can understand that the session will be very lengthy. So I'm trying to provide you the brief understanding. Okay. Okay, so RBI had announced the Shark currency swap framework. So for the Shark country, for the South Asian Association of South Asian Association of Regional Cooperation, so it has like members. Bhutan is there. India is a member of Shark. So for India, for the other Shark members, the India launched a swap framework that if a Shark nation is under the balance of payment crisis, so India will provide you the dollars. Okay, you can give your currency to India and India will provide you dollars for a short period of time, and the currency swap framework or the currency swap, that is the dollars or the euro that we are providing, that is for the short term. This had the limit of $2 billion. $2 billion. Now it has been said that under the currency swap framework of 2024-27, we have brought a separate INR swap window that we are going to provide rupees to you. If you are in the balance of payment crisis, you can use your rupees to do the transactions with us or with the other countries. You can use the rupees for the international transactions, and you can give us your currency and we will give you the rupees, and the INR swap window will be provided at very high concessions. Okay, so there is a Shark currency swap framework that we provide to the other countries so that they can surpass their balance of payment crisis. So a separate INR swap window has been introduced with various concessions for swap support in Indian rupee. The total corpus of the rupee support is rupees 250 billion. Yes, it is 250 billion rupees. I hope this is clear. So simply, the Shark currency swap framework has been present since 2012. But we were providing the swap facility in US dollar and euro, that if you want the US dollars or euro, you can take it from India and you can provide your currency to us. You can swap the currencies. So this window was having the overall corpus of US dollar 2 billion. So in this new framework of 2024-27, we have decided to open a INR swap window that is like we will provide rupees. So the swap window of dollar euro is present, but we have provided a separate swap window of rupees also that that is having the limit of rupees 250 billion, and the INR swap window is having more concessions for swap support. Okay, so Bangladesh, Bhutan, India, Maldives, Nepal, Pakistan, Afghanistan, Sri Lanka are part of Shark. Okay, next question, try to answer this question. So the term bulk deposit would now mean single rupee. So bulk deposit has been quite in news recently. Bulk deposit question was in the previous year, it was in the IFSCA. There was a question of bulk deposit. So now in the phase 1 of RBI, there can be a question on the bulk deposit. So try to answer this. So the term bulk deposit would now mean single rupee term deposit of rupees 3 crore and above for scheduled commercial bank and small finance bank. Absolutely correct. Bulk deposit mean single rupee term deposit of rupees 1 crore and above for local area banks and regional rural banks. So this is wrong. It is not 2 crores, it is 1 crore. The term bulk deposit would now mean single rupee term deposit of rupees 15 lakh and above for all the other cooperative banks, that is other than scheduled urban cooperative bank tier 3 and tier 4. So this is correct. So first statement and third statement are correct and you have to find the correct statement. So the answer is 1 and 3. Yes, very good. Okay. For the scheduled urban cooperative banks, that is in the tier 3 and tier 4, the limit for them, the bulk, sorry, not the limit, but the bulk deposit is the single rupee term deposit of 1 crore and above. Okay. So this is the idea. So here, for bulk deposit is the single rupee term deposit of rupees 3 crore and above for scheduled commercial bank excluding regional rural banks, and for the small finance bank the bulk deposit is the single rupee term deposit of 1 crore and above for the regional rural banks and local area banks. Bulk deposit is your single rupee term deposit of rupees 1 crore and above for the scheduled urban cooperative banks in the tier 3 and tier 4, and the bulk deposit is single rupee term deposit of rupees 15 lakh and above for all the other cooperative banks. Okay. Next is that there was a Harbringer 2024, the third global hackathon that has been recently conducted by the Reserve Bank of India. Which of the following are the two themes of the hackathon. So actually in the Harbringer 2024, there were two themes. So there were two themes. Under the first theme, there were 3 problem statements. Under the second theme, there was only 1 problem statement on which the solutions were taken by the RBI. Okay. So the two themes were zero financial frauds and being Divyang friendly. Okay. So this is the idea. For RRBs, it is 1 crore. And for the local area banks, it is 1 crore. Okay. Yes. So 1 and 3 is the answer. 1 and 3 is the answer. So these are the two themes. That is the two themes of the hackathon were the zero financial frauds that were having 3 problem statements, and being Divyang friendly that was having only 1 problem statement. Okay. So this is the whole idea. Now coming to the next question, that is okay. Sorry. So now coming to the next question, that is recently the Reserve Bank of India has decided to create a dedicated platform to address the digital payment frauds in the country. So there is going to be a platform that will be made. So that is the Digital Payments Intelligence platform that will be made. So for that, the Reserve Bank of India has constituted a committee with the chairman AP Hota, Shri AP Hota is the chairman of the committee. So Reserve Bank of India has decided to create a dedicated platform to address the digital payment fraud, and this platform will use the network level intelligence and the real time data sharing between the different entities. And to take this initiative forward, there is a committee that has been constructed, and the chairman of the committee is Shri AP Hota, who had to this committee had to provide the recommendations within 2 months. Now coming to the next question, that is the PSL framework, the priority sector lending framework. This has an incentive framework. Okay, that is the districts that are having less priority sector lending, if additional lending is provided to such districts, if additional priority sector lending is provided to such districts, it will be taken at a higher weightage. While if there are districts that are having too much of the PSL, so if additional PSL is provided to such districts, this will have a lower weightage. So this is the incentive framework that is going on for the priority sector lending, and there is some updates that has been provided in this incentive framework recently by the RBI. So kindly try to answer this question. Yes. So with effect from financial year 2024-25, a higher weight of 125% shall be assigned to the incremental, to the additional priority sector lending, that is to the identified districts where the credit flow is comparatively lower, that is per capita PSL is less than 9,000. Per capita PSL, the priority sector lending is less than 9,000 per capita, and a lower weight of 90% will be provided to the additional credit to the priority sector areas in the identified districts where the credit flow is too much, that is more than 42,000 per capita is the priority sector lending flow that is happening to these districts. So the weightage will be 90%. The districts other than those mentioned in the first or second list, so the other districts will have a weightage of 100%, that is the normal weightage. So first and second statements are actually correct, the third is wrong, and that's why you have to find the incorrect statement. So 3 only, that is E is the answer here. Okay, I hope this is clear. Yes. So earlier the limit for the lower, the districts with lower PSL, for them the criteria was that per capita PSL is less than 6,000. Now with the districts with lower PSL, the criteria is per capita PSL is less than 9,000. Now with the districts having higher PSL, the criteria was that the PSL is greater than 25,000. Now the criteria is that the PSL is greater than 42,000. So this is the change that has happened. For all the other districts, the 100% is the weight. Okay. Now coming to the next question, that an enterprise shall be classified as a medium enterprise where the investment in the plant and machinery or equipment does not exceed what, and the turnover does not exceed what. Easy question. And this, in the RBI grade B in the previous year, such a question has been asked. So kindly try to answer this question. Yes, the answer is 50 and 250. Okay, so the definition is that for the micro enterprises, the investment should not be more than 1 crore and the annual turnover not more than 5 crore. For the small ones, the investment not exceeding 10 crore and turnover not exceeding 50 crore. For the medium enterprises, the investment not exceeding 50 crores and turnover not exceeding 250 crores. So this is the idea. Now the MSME should be engaged. Before it was said that a certain MSMEs, if the loan is given to these certain MSMEs, then it will be classified as PSL. So if the banks are giving loans to a certain MSMEs, then the loan will be classified as PSL. Now it has been said that all the bank loans that is given to any MSME for any reason, that will be classified under PSL. So the criterias have been demolished and now all the bank loans to MSMEs shall be classified as PSL. Try to answer this question. Now we only have 5-6 more questions from your RBI notifications. Then we will move forward with your finance current affairs. Okay. Okay. So on a balance of payment basis, the foreign exchange reserves increased by US dollar how much? $63.7 billion. Okay. So this is the idea. Yes. On the balance of payment basis, that is on the in the current account, there was deficit of $23 billion, while in the capital account, there was surplus of $87 billion. So in total, on the balance of payment basis, the reserves were $63.7 billion. Okay. Now what has happened that in the foreign exchange reserves, the RBI also keeps gold. Gold prices are increasing, and with the increase in gold prices, the valuation gain has happened. So on the balance of payment basis, the foreign exchange reserves have increased by $63.7 billion, while on the basis of the increase in the value of gold, the increase in the value of gold is $4.3 billion. So in total, it is $68 billion. Okay. That is the including the valuation effect, the foreign exchange reserves have increased by $68 billion. Try to answer this question now. Okay, so I hope you were able to see the data. This was the data. Okay. Now try to answer this question. India's current account balance recorded a surplus of US dollar 5.7 billion. Yes. So that was 0.6% of the GDP. So in quarter 4, if I say that for the financial year 2020, if I say for financial year 2023-24, there was a deficit, there was current account deficit of what percentage of the GDP for 2024-25? For financial year 2023-24, for the financial year 2023-24, the current account was in deficit of what percentage for this financial year? What percentage of GDP? In the financial year 2023-24, the current account was in deficit of what percentage of the GDP? Yes, it was 0.7% of GDP. Okay. So first of all, India's current account balance recorded a surplus of 0.6% of GDP during the 4th quarter of the financial year 2023-24. Okay. For the financial year 2023-24. Okay. For the 4th quarter, there was the current account balance surplus that was there. Now, if we see that the India's current account deficit for the whole financial year, not only a quarter, for the whole financial year, the India's current account deficit was at 0.7% of GDP during 2023-24. That was lower than the 2% of GDP. Yes, it was 0.7%. Here, it has been asked about the surplus in the quarter 4. So surplus was 0.6% of GDP in quarter 4, while for the full financial year, for all the quarters included, the deficit was there in this current account, that was 0.7% of GDP. Okay, now try to answer this question. At end March 2024, India's external debt was placed at $663.8 billion. Now, the external debt to GDP ratio, the external debt has increased, but the external debt to GDP ratio has declined because the external debt has increased, but the GDP has increased by more, so denominator is increasing by more. So the external debt to GDP ratio has declined to 18.7%, that is lower than 19%. Okay, so this is the basic idea, that the external debt to GDP ratio has declined to 18.7%. Now the share of short-term debt, with original maturity up to 1 year in total external debt declined to 18.5%. The US dollar denominated debt remained the largest component of India's external debt with share of 53.8%. That is, all the debt that we have taken, the highest is in the form of US dollar, and that was having the share of 53.8%. Now coming to the next question, this is again very important, that recently the review has been undertaken for the ways and means advances limit. Okay, so the Reserve Bank of India provides the short-term loan. The Reserve Bank of India provides short-term loans to the state governments, to the union territories, to the central governments, but for the state governments and for the union territories, there is the review of limit that has happened, and the limit has been increased from 47 crores to 60 crores. Okay, so that is the B is the answer here. Okay, so yes, so ways and means advances, it has been said that there is the increase in limit to 60 crores for the state governments and union territories from July 1st, 2024. This is effective from July 1st, 2024. For the spatial drawing facility, it has been said that the spatial drawing facility, so it has been said that the spatial drawing facility, that is the maximum limit, the highest limit of the spatial drawing facility is 50% of the outstanding balance or 50% of current balance of the CSF or GRF, and the 50% of the outstanding balance or the 50% of the current balance in the auction treasury bills. So the SDF highest limit is your how much the state governments have invested in the CSF and GRF, 50% of that or 50% of the auction treasury bills. Let's say a state government has 100 rupees of auction treasury bills. So the spatial drawing facility limit is 50 rupees. That is 50% of the auction treasury bills that you own. Now, what is the SDF? What is the WMA? What is the overdraft facility? All of this we have discussed in a previous session. So SDF is just the loan that the state governments can take against the collateral that the state governments are providing. The collateral in the form of consolidated sinking fund, the guarantee redemption fund. So the state governments or union territories have investment in the CSF or GRF. So against their investments as a collateral, they are taking loan from the RBI. Okay. Now this SDF can also be taken, it is a loan that can be taken from the state governments or union territories against the collateral that the state governments are providing in the form of auction treasury bills. So they have different rates. Okay. WMA is for meeting the shortfall or for meeting the short term, like the expenditure is more than revenue. The state governments are spending more than receipts of the state government. So for the short term, the state governments require the money, so they can take it from the Reserve Bank of India under the ways and means advances. Now if the state governments want more of the loan, so they can take it under the overdraft facility. Okay, so this is the whole idea. Now this we have discussed that the WMA limit has been increased for all the state governments and union territories. This is the aggregate limit. For the spatial drawing facility that the RBI provides to the state governments and to the union territories against a collateral. So for that the limit has been made 50% of the outstanding balance or the current balance that is in the CSF, GRF or your auction treasury bills. Okay. So this is the idea. Now just read it and you will understand everything. Just go through it once. Sorry. So try to answer this question. So it is necessary that the SRO operates as a true representative of the sector. So SRO, for the SRO NBFCs, there are some guidelines that have been released. So which of the following criteria is or are incorrect? First of all, SRO NBFC is for the NBFC investment and credit companies, NBFC housing finance companies, NBFC factors. To ensure a fair representation of the smaller NBFCs, at least 10% of the NBFCs in the ICCs and the factors should be from the base layer, that is the lowest of the layers of your NBFCs. Failure to achieve the membership within 2 years would revoke the recognition of SRO. So if you have not achieved the membership within 2 years, so the revocation of your recognition can happen. The applicant of SRO for NBFC should achieve a minimum net worth of 2 crore within 1 year of achieving the recognition. The maximum of two SROs of NBFC sector will be recognized. This is what the RBI has said. So the incorrect statement is only E. E is the incorrect statement. Okay. Yes. So the maximum of 2 SROs for the NBFC will be recognized. The applicant should achieve minimum net worth of 2 crores within a period of 1 year. So these are the guidelines for the SRO NBFC. Now the applicant of SRO for fintech. So there are the SRO that is going to be for the fintech companies. So there are some fintechs that are regulated by RBI, such as NBFC, account aggregators, NBFC peer-to-peer lending platform. So these are the NBFCs that are the fintech that is regulated by RBI. Now there are some fintech companies that are not regulated by any regulator. So the SRO fintech can have the NBFCs that is regulated by RBI as a member of SRO fintech, but maximum membership of SRO fintech should come from the unregulated fintechs, so that there is some linkage between the unregulated fintechs and RBI, that is through the SRO. So the applicant of SRO for fintech should achieve a minimum net worth of rupees 2 crores within a period of 1 year for the recognition of SRO as a fintech. So that is 2 crores within a period of 1 year. So the guidelines for the here is same, we can say. So applicant should have a minimum net worth of rupees 2 crores within a period of 1 year after recognition as an SRO fintech. Okay. So the membership criteria is that the membership in the SRO fintech should be primarily from the fintechs that are currently not regulated by any regulator, and the membership may also be open for the regulated entities such as the NBFCs, account aggregators, NBFCs, peer-to-peer lending platform that is regulated by the RBI. Other than banks, banks can never be under the SRO fintech. That is the idea. Now the SRO fintech should be domiciled or registered in India, but the SRO fintech could have fintechs as members that is domiciled outside India also. Now try to answer this question. SRO for financial market. Financial market means the money market, forex market, your repo market, repo operation market. So that is financial market. Okay, financial market. Then there is the SRO for banks, SRO for NBFCs, SRO for fintech. So SRO NBFCs are going to focus on the investment and credit companies, housing finance companies, and your factors. SRO for fintech can have other NBFCs as its members as well as the other fintechs as its members. Okay. But the SRO fintech can never have the banks as its members. So here the Reserve Bank of India has held its 18th annual Statistics Day conference. This was in recognition of present, like the National Statistics Day we celebrate on 26th June every year in the celebration of PC Melbourne. Okay. So I hope this is clear. SRO is self-regulatory organization. Yes. So National Statistics Day is celebrated, every year 29th of June. My bad, yeah. So National Statistics Day is celebrated on 29 June every year to acknowledge and appreciate the exceptional contribution made by the Professor PC Melbourne. Now the National Statistics Day was first celebrated in 2007, and since then we are celebrating this day. The Reserve Bank of India has held its 18th annual Statistics Day conference that was named RBI Statistics @90. This was in recognition of Professor PC Melbourne. Now recently Suresh Tendulkar was also in news. So RBI, the Reserve Bank of India, has conducted the 4th memorial lecture in the recognition of the work that has been done by Suresh Tendulkar. So first memorial lecture was in 2013, and since then this is the fourth memorial lecture that has been conducted recently. Okay. So now we have completed, like we have done the important topics from your RBI notifications, from your RBI website. There was a news article regarding BDDR that we are going to discuss at the end. Now let's start with our finance current affairs. Okay, so answer this question. We are starting with the finance current affairs now. So recently in August 2024, the National Highways Authority of India made headlines that it has done a prepayment. It has done a prepayment of debt. So prepayment of debt has been done by the National Highways Authority of India, and it has saved 1,000 crores in the prepayment of debt. Now this is successfully prepaid a bank loan of 15,700. Now this was a news article that was in PIB. So this is the idea. So answer is D here, that the National Highway Authority of India has saved around 1,000 crores of interest by prepaying 15,700 crore of the money. So this is prepaid to the banks. Now how the National Highway Authority of India has generated this much amount of money, that is through the InvITs. So I hope you know that the InvITs, they are the Investment Infrastructure Trust. This is a collective investment scheme that collects the money, that takes the money from the investors at that and invests this money to the in the infrastructure projects. Okay, so InvIT, it is a collective investment scheme that collects the money from the investors and invest this money in the infrastructure projects. So this money was collected by the InvIT and was given to the National Highway Authority of India for their projects. So this money was used by the National Highway Authority of India for the prepayment of the loan. Now try to answer this question. Securities and Exchange Board of India has recently launched an AI based chatbot that was named What, to assist investors and enhance the investor protection. So try to answer this question. Yes, it was named Seva. So Sarthi is an app of SEBI, that is an application of SEBI. Okay, Prava is a platform for regulatory approval, validation and authorization. So that is a platform of the Reserve Bank of India for your approval, validations and authorizations. Antardrishti is a dashboard of the Reserve Bank of India. Drishti is nothing else, it is just a name here. So Seva is the answer, that is a chatbot. So Seva, the SEBI, that is Securities and Exchange Board of India, has released an artificial intelligence based conversation platform for the investors, so that the investors can ask their questions and can get the information regarding the securities market, regarding the latest master circular of the SEBI and such. Okay. Next is a question regarding the proposed framework of the SEBI. So there is a proposed, see what was happening, that there was a loss, huge loss that was made by the retail investors in the FNO segment, in the futures and options segment. Futures and options are the derivative contract. So this is present in your stock exchanges. So you can trade in the futures and options in your stock exchanges. So the retail investors, as they do not have much knowledge about the derivatives, still they were trading in the derivatives. So they were making huge losses in the derivatives. So SEBI has proposed amendments in the derivatives trading framework. So SEBI plans to reduce the number of weekly option contracts from 18 to 6 per month, while the monthly contracts will remain the same. Set for the 4th week of the month will remain unchanged. So this is correct. Minimum contract size. Before, the minimum contract size was between 5 to 10 lakh, which is going to be increased, because we want the retail investors to not blindly enter the futures and options market. So the limits are being increased from 5 to 10 lakh to 15 to 20 lakh, and later on this will be further increased from 20 to 30 lakh, from 20 to 30 lakh. Extreme loss margin will increase from 3% an additional 5%. Okay, so second and third statements are wrong, only the first statement is correct. So here 2 and 3 is the answer. Very good. So incorrect statements are 2 and 3. Okay, So this is the basic idea, that SEBI has proposed significant amendments to the derivatives. Like, this is just a proposal, remember this. Number of weekly option contract will be reduced. The minimum contract size, before it was 5 to 10 lakh, now it will be in between 15 to 20 lakh and 20 to 30 lakh in the later on periods. Extreme loss margin. Loss margin means additional margin that is taken above the normal margin, so that is increased to 3% and additional 5%. So this is the idea. Now, expert panel led by Dash recommended new arbitration and mediation laws for the IFSC at the GIFT City. So in our country, we have International Financial Service Center, that we consider a international platform for the financial transactions. Now, this IFSC in our country, it is present in GIFT City, that is the Gujarat International Finance Tech City. So we have one IFSC in our country, that is International Financial Service Center, that is present in Gujarat in the GIFT City. So the IFSC is regulated by IFSCA, that is International Financial Service Center Authority. So expert panel that was led by MS Sahu recommended new arbitration and mediation laws for the IFSC. Okay, so here the answer is MS Sahu. So IFSCA formed the committee to draft the rules to provide a draft guidelines to set up an alternative dispute resolution center in the GIFT City in May 2023. This committee was constituted so that the alternative dispute resolution center and the guidelines regarding this can be framed. Okay, so try to answer this question, that as per the committee, as per the MS Sahu panel, they have proposed a dash day time limit for filing an appeal against the arbitral award. That means if the arbitration center is saying that you have to pay a fine of 5 lakh rupees, that is a arbitral award, or that is a arbitral decision that is taken by a arbitration authority. Let's say that you have made a loss of 10 lakh rupees because of a seller, but the arbitration center is saying that okay, you will get the refund of 2 lakh rupees. So you are not happy with it because you have made the loss of 10 lakh rupees. You want 10 lakh rupees or more than that. So you can like file an appeal against the arbitral decision, against the arbitral award. Before, the window for filing an appeal was 90 days, but the MS Sahu panel has said that the window should be shortened and it should be 21 day time limit that should be provided for filing an appeal against the arbitration decision. Okay, so that is 21 day time limit is going to be there. So 21 day time limit for filing an appeal against the decision under the Arbitration and Conciliation Act. So this has been proposed, like before it was 90 day, or currently it is 90 day. The proposal is to reduce it to 21 day. So now it has also said that the committee has recommended that the ADRC, that is the that is your arbitration dispute, alternative dispute resolution center. So alternative dispute resolution center, for that the center should be established as a Section 8 company, that is a not-for-profit company under the Companies Act of 2013, and it has been said that in the phase 1, the Gujarat High Court should be dealing with matters arising out of the center in the GIFT City. So if there is a case that has not been resolved by the center, or there is a case like you have to go to the higher authority, so the High Court, there should be a separate bench that should be in the Gujarat High Court to deal with the matters arising of the ADRC in the GIFT City in the phase 1, and in the second phase there should be a separate special High Court that should be there for dealing with all the IFSC related issues. Okay, the special High Court shall be named IFSC Central International Court, IFSC International Court, and shall have all the powers of the High Court excluding or other than the writ and criminal jurisdiction, because in the IFSC we are dealing with financial transactions. The international authorities, the international entities, and our entities, we are dealing in the financial transactions in the International Financial Service Center. So there should be a IFSC International Court for handling the disputes in the financial transactions. So this is in the third phase. International judges should be invited for sitting in the IFSC International Court, as this is a prevalent practice in Singapore and Dubai. Okay, so this is regarding the whole idea. Now try to answer this question. So see, we have mutual funds in which the retail investors invest. Like you can even invest 100 rupees. You can even start from 100 rupees, 1000 rupees, and you can invest that much also in the mutual funds. Okay. Retail investors are the small investors, and so the mutual funds have to follow a huge amount of guidelines, huge regulations. Huge amount of regulations have to be followed by the mutual funds. So they are quite restricted, very much restricted, because they are handling the money of the retail investors. And for us, 100 rupees, 1000 rupees, 10,000 rupees is also very valuable. Okay. Now there is another category of PMS, that is the portfolio management service providers that provide customized products, financial products. Like if, but you can invest in the PMS only 50 lakhs and above. Now there are, like, some people want the customized products, or some people want the special products where their needs are being catered to. Let's say I want to take more risk and I want more returns, or let's say I want to take less risk but I want good returns for my retirement. I want a retirement plan in the investment products. Okay, so for my customized needs to be met, now it can only happen, the customized products will only be provided to me when I invest more than 50 lakhs. That much money I do not have. So it has been said, it has been proposed by the SEBI that a new asset class will be introduced that is going to be in between the PMS and the mutual funds. So the new asset class allows the mutual funds or asset management companies that have been in operation for more than 3 years, for at least 3 years we can say, with an average asset under management of 10,000 crores. So they can handle this new asset class. The minimum investment size in the new asset class will be 10 lakh rupees. So that is way lesser than 50 lakh rupees. Similar taxation to mutual funds will be there, where no tax is incurred on the mutual funds until they have sold some investment. Okay. So here the first and third statements are correct. The second one is wrong, and that's why 1 and 3 is the answer. So this is the answer. So this is the new product that is in the midway of the PMS, or that is in midway of the PMS and the mutual fund. So minimum investment size is required 10 lakh for the new investment, product, or for the new asset class, making it more accessible than the PMS, that is the product management service. This has a minimum threshold of 50 lakh rupees. Okay, so there are greater flexibility that is provided. So for the mutual funds there are very high guidelines, very high regulations that have to be followed, while in the PMS very low regulations that have to be followed. So in the new asset class, there will be relaxed operating guidelines that will be followed compared to the traditional mutual funds. So mutual funds have to follow very high guidelines, very high regulations. So the new asset class will have to follow the relaxed guidelines, will have to follow the relaxed operating guidelines. Okay, now try to answer this question. Recently, the Securities and Exchange Board of India has proposed new regulations concerning the offshore derivative instruments and foreign portfolio investors. So what happens that, let's say the SEBI has authorized the foreign portfolio investor to invest in the securities, shares, bonds, derivatives in our country. So FPIs, they can invest in the securities in our country. Now there are some foreign investors that are not able to invest in our securities because they have not taken the authorization from the SEBI. So foreign portfolio investors, they used to sell the participatory notes, or they used to sell the offshore derivative instruments to the foreign investors. So foreign investors used to provide some money to the FPIs and used to take the ODIs from the foreign investors. Now ODIs, offshore derivative instruments, this were deriving the value from the securities of the Indian market. Okay, so this was deriving the, see, these were bought by the FPIs, that is registered with SEBI, but the benefits of these instruments were going to the foreign investors that are not registered with SEBI. So David, who is a foreign portfolio investor, is registered with SEBI and he can invest in the securities of our country. But John is not registered with SEBI, so he cannot invest in the securities of our country. So the David is buying the securities and is selling the ODI to John. So John is able to have the exposure to our securities indirectly. So SEBI has proposed, see, SEBI has the information about the FPIs, but SEBI do not have the information regarding this foreign investors that are not registered with SEBI. They are having the exposure in our securities. They are having the control over our securities because they are buying and selling it through the FPIs. But we are not aware about them because they are the offshore units that are not registered with SEBI. So SEBI has proposed that ODIs, that is the offshore derivative instrument, shall first of all have only cash equity, debt securities, or any permissible investment by the FPIs. That means the ODIs cannot be sold to the foreign investors if the ODIs are connected with the derivatives. So other than derivatives, first of all, SEBI plans to make separate registration. So currently the category 1 FPIs can sell the ODIs. Now it has been said that separate registration will be required for a FPI if it wants to sell the ODIs. Okay, as well as the offshore units or the investors that are investing in the ODIs, their information has to be provided to the SEBI. This has also been said. So existing ODIs with the derivatives, they have to be, if this proposal is accepted, so the existing ODIs with derivatives, they have to be finished within a time period. Okay, so this is wrong. They are not indefinitely. This has to be finished faster. First and second are correct. So you have to find the correct statement. 1 and 2 are correct. So SEBI has proposed to extend the disclosure requirements to ODI subscribers who are purchasing the ODIs. They have their information should go to SEBI also. So now it has been said that SEBI plans to make the separate registration mandatory for FPIs who are issuing the ODIs, and the ODIs cannot be released against the derivatives. That means the foreign investors that are not registered with SEBI, they should not be having the access to derivatives even through the ODIs, So the use of derivatives should not be allowed for the ODIs. ODI shall only have the cash, equity, debt, securities and such. Okay, the existing ODIs with the derivatives as the underlying will be required to be redeemed within a year once these proposed norms are made effective. So this is the idea. Now try to answer this question. Recently, in August 2024, the SEBI amended the alternative investment fund norms. SEBI has permitted the large value funds for accredited investors to extend their tenure by up to 5 years. Okay, by up to 5 years. Yes. So the basic idea is that the SEBI, the large value funds are the funds where the large investors are investing. So it has been said that if 2/3 of the unit holders, they agree, then this large value funds can be extended, the tenure of the large value funds can be extended by 5 years, up to 5 years, sorry. Okay, so the tenure of the large value funds can be extended up to 5 years. Now recently in August 2024, the Banking Law Amendment Bill 2024 was introduced in the Lok Sabha. Which of the following statements are incorrect regarding the proposed changes in the bill? So first of all, the bill proposes to increase the nominee option from 1 to 4. So before you could only have 1 nominee, now you can the bill proposes to have 4 nominees. The bill redefines the substantial interest for directorship. So a person or an entity is having a substantial interest, that means a significant influence over the bank. It was said that if an entity has 5 lakh worth of the shares, then this entity is having a significant influence over the bank. So now it has been said that we have to increase the threshold from 5 lakh to 2 crore. That if the entity has 2 crore of the shares, then it can has significant influence in the bank. So 5 lakh to 2 crore, this is correct. The bill proposes that the maximum consecutive tenure for the directors of the cooperative bank should be increased from 8 years to 10 years, not 12. Okay. So first and second statement is correct, third is wrong. So 1 and 2 is the correct statement, but you have to tell the incorrect statement. So 3 is the answer. 3 only is the answer, that is E is the answer here. Okay. Yes. So these are some of the amendments that have been talked about in the Banking Law Amendment Bill. Nominee has to be increased from 1 to 4. Before, the threshold for the substantial interest was 5 lakh. Now it is proposed to increase 5 lakh or 10% of the shares. Now the 5 lakh limit has to be increased to 2 crore. This is the proposal. So the regulatory reporting should happen on the fortnightly basis, where fortnight should mean 15th and the last day of each month. Fortnight for the cash reserves should also mean the period of 1st to 15th, that is till 15th, and from 16th to the last day of the month. Okay. Tenure of directors should be increased from 8 to 10 years, except for chairman and whole-time director. prohibition on common directors, there is exemption that is provided that the common directorship in cooperative banks should be allowed, allowing directors of central cooperative banks. So central cooperative banks, they can serve on the boards of the state cooperative banks, like it is same exemption is provided to RBI appointed directors also. So there is an exemption. Usually what happens that the common directors cannot happen in the cooperative banks, but exemption is provided that if a director is there in the central cooperative bank, then the same director can be in the board of the state cooperative bank also. So there is a exemption. Settlement of unclaimed amount. So the unclaimed, like unclaimed shares, unclaimed dividend, this has to go to the investor education and protection fund within 7 years. So if the shares dividends are unclaimed for 7 years, it has to go to the investor education and protection fund. Okay, now there is more of the things that are brought under this investor education and protection fund. Remuneration of auditors, that has to be decided by the banks. Till now it is decided by the RBI and the central government. So it is said that the bill is granting the power to for the banks to decide the remuneration of auditors. So this is what the bill is proposing. Now coming to the next question, try to answer this question. Recently in August 2024, the property share became the first fractional ownership platform to receive the small and medium real estate investment trust license from SEBI. So recently in March, April, in that time period, it was said that in the real estate investment trust collects the money from the investors and invests the money in the real estate. So there will be a small and medium real estate investment trust that will be there. So this was said around March 2024 or around that time period. So property share has become the first fractional ownership platform, that is the first small and medium REIT, we can say. The small and medium real estate investment trust framework covers both commercial and residential properties with asset value between 50 crores and 500 crores. So here the E is the answer here. Okay. So small and medium REIT is a type of REIT that allows for fractional ownership. So in the small and medium REIT, there is the fractional ownership that can be allowed in real estate. Fractional ownership means that the ownership of a real estate of a building is with the multiple investors, that they co-own the property and they are having the sharing in the cost and the benefits. So that is the basic idea. In the small and medium REIT, there should be minimum of 200 investors and the asset that they are acquiring, that should be within 50 crores to 500 crores. Now another question that is from the small and medium REIT. Okay, so there is a mistake that has happened. Just a second. So this is not a part of this question. Okay, just cut this out. I will change it in the PDF. Okay. So companies, see the investment companies and the investment companies and the investment holding, sorry, the investment and holding companies. So the investment and holding companies, if they wanted to delist their shares from the stock exchanges, okay, they want to delist it. So before there was the provision of reverse book building, that they had to ask the shareholders or the people that are having the shares to sell their shares to the promoter, to the owner, to the actual owner of the company. So the shareholders used to say very high prices for selling back their shares. So usually the delisting was not possible because very high prices were asked by the shareholders. Now it has been said that for the delisting of the shares, there is another mechanism that is also provided, that is the fixed price mechanism, where as per the rules set by the regulator, set by the SEBI, there will be a floor price that will be decided, and for the delisting, the 15% higher of the price has to be decided from the floor price. Okay, so floor price will be decided as per the norm set by the regulator and above the floor price. So fixed price must be at least 15% above a floor price, and on this price the delisting can happen. The shares can be bought back by the promoter. So 15%. So before there was only one mechanism that was provided for delisting of the shares, that was reverse book building, but it was very complicated process because the shareholders were the ones that were saying very high prices for selling their shares to the company, to the entity. Okay. Now one more thing has been said, that in the reverse book building process, if that process is followed, the regulator has reduced the threshold for a counter offer. The counter offer can be made by a company, by the entity. The shareholder has said that we will sell the shares for, let's say, ₹1,000. So if before, the counter offer can be made by the company when the company has received 90%, or when the company has got 90% of the shareholding. Okay, when the promoter has got 90% of the shareholding. Now the SEBI has allowed that the regulator has reduced the threshold for the counter offer to 75%. That means if the company has 75% of the shares, it can make the counter offer, and at least 50% of the public shareholding has been tendered, has been provided to the promoter. So this is a process of delisting. Okay. So this is the idea. Now try to answer this question. Total questions are 70. So recently in August 2024, the Union Finance Minister chaired review meetings to assess the performance of public sector banks. So public sector banks recorded their highest ever net aggregate profit of 1.45 lakh crore. Okay. So A is the answer here. Yes, 1.45 lakh crore. They have got the net interest margin, that means how much interest they have earned on the loans minus how much interest they have paid on the deposits. The interest they have paid on the deposits. So the net interest margin was 3.22%, and the other data points are provided here for the public sector banks and for regional rural banks. Next is, yes. Recently, in August 2024, the Reserve Bank of India formed a committee to review the fee structure for white label ATMs. White label ATMs, they are the ATMs of not a particular bank. They are the ATMs that are provided by the non-bank entity to promote the access of ATMs and to provide the access of ATMs to all the people in the country. So a committee is going to review the fee structure for the white label ATMs. So the committee is headed by Sunil Mehta. Very good. Okay. Now next is Dash accounted for the highest share of foreign portfolio investors investing in India during fiscal year 2023-24. US. So US has accounted for the highest share of foreign portfolio investors that is investing in India during this financial year, that is 2023-24. Okay, so total number of registered foreign portfolio investors in India reached 11,219, led by US, Luxembourg and Canada. Next is that the NPCI, there is Bheem. There is Bheem app that provides the UPI services. So NPCI has made a subsidiary. Okay, so National Payments Corporation of India has made a new subsidiary of the UPI based payment application Bheem. Into a separate subsidiary has been created by the NPCI, that is the NPCI Bheem Services Limited. So till now there is the NPCI International Payment Limited, that is NIPL. There is NPCI Bharat Bill Payment Limited, that is NBBL, and there is a new subsidiary that is created by the NPCI, that is the NPCI Bheem Services Limited, that is your NBSL. So this is the third, yes, this is another subsidiary of the NPCI, another important subsidiary of NPCI. Lalita Natraj is going to be the CEO of the NBSL, that is correct. Bheem is the Bharat interface for money. So this is wrong. So third statement is wrong, and that's why the answer is that you have to find the correct statement. So only 1 and 2 is the correct statement. So the third statement is wrong, and that's why 1 and 2 is correct, and the answer is E here. Okay, E here. Yes, very good. So it is Bharat. It is Bharat. Bheem is your Bharat interface for money. Now a Mumbai-based fintech startup Dash received NPCI certification to operate the UPI based payment infrastructure. So this fintech startup has got the UPI acquirer, the UPI issuer kind of position, and as well as this fintech startup is also going to implement the UPI UDIR, that is Unified Dispute Issue Resolution. So if there is any kind of dispute that is arising, complaint that is arising, so this startup will take care of that. So this startup is TechFini. Okay, this startup is TechFini. Yes, very good. So TechFini is the one, the Mumbai-based fintech startup TechFini has received the NPCI approval to work as a UPI-based payment infrastructure provider and the implementer of the UPI UDIR. The status finalization, confirmation of refund, the ability for the consumers to raise complaint, that is through the UDIR, that will be implemented by the TechFini now. Okay. Now next is the government has extended the deadline for central public sector enterprises and public sector financial institutions to meet the minimum public shareholding norms. So there is minimum public shareholding, that means a company that is listed on stock exchanges that should have some minimum public shareholding, that is 25%. Okay. So this has to be achieved until like by August 2026 as per the government norms. So 25%. Yes. So this is the basic idea. So government has extended the deadline for the CPSC and the financial sector, public sector financial institutions to meet the minimum public shareholding norms until August 2026. So it provides exemption to increase public shareholding too. So the government has extended the deadline for the entities to meet minimum public shareholding norms until August 2026. It provides exemption to increase public shareholding to at least 25%, with CPSC is below 25%, getting an additional 2 years for compliance. So this is the basic idea. Okay. Now next is NPCI introduced a new feature called Dash on its UPI platform. So recently in the recent August Statement on Developmental and Regulatory Policy document, it was said that there will be delegated payments. That I have a UPI ID. That is Kritika. I have a UPI ID. Now I want my brother, my younger brother, to access the UPI ID because he is going to college. He will be making some expenditure. So I want him to be able to access my UPI ID and to spend for his traveling, for his food needs. He can spend from my UPI account. But let's say I have 50,000 in my UPI account. So I can permit my brother to use a part of the money. Okay. So that is delegated payments. So for this kind of system, there is the UPI circle facility that has been developed by the NPCI. So RBI said that we need such a facility for the delegated payments, that I am the primary user. I can delegate some of the part of my money for the usage by my brother, by my family members, relatives and such. So for that there is a UPI circle. I hope this is clear. Okay. So this is the basic idea. Okay. So National Payment Corporation of India has introduced a new feature, that is UPI Circle. UPI Circle feature allows a primary user to delegate the payments to the secondary user. The secondary user can use the same UPI ID for making the payments. There can be full delegation. That means secondary users can complete the transactions within the predefined limits without further approval. But the monthly limits are 15,000 for the delegated payments, and the per transaction limit is 5,000. Partial delegation is whenever my brother do any transaction, authorization will be provided by me only. So that is, I can look after all the transactions that he is initiating. So this is the full delegation or partial delegation. So I am delegating some payments that can be made by my brother through my account, but I can provide full delegation where he will not need any kind of authorization from my end within the predefined limits, or there can be partial delegation that all the payments authorization will be provided by me. Okay, so that is UPI circle. Now BBVA Colombia, BBVA Colombia and the Dash issued the world's first biodiversity bond. So many entities release the green finance bonds. Many entities release the green finance bond for the green infrastructure, for the solar power plants, for the hydropower plants and such. But this is the first time when the world's first biodiversity bond has been released for reforestation and such things. Okay, so BBVA Colombia and the IFSC, they have issued the world's first biodiversity bond. So IFC is the institution under the World Bank Group. So World Bank Group have 5 institutions, out of which IFSC is also there, that is the International Finance Corporation. So BBVA Colombia and IFSC, remember this very clearly, they have issued the world's first biodiversity bond. Now there are some like first tranche 15 million will be raised, and further like total money that will be raised will be 70 million. Next question is, SEBI has introduced a new framework involving the stock exchanges in the administration and supervision. So, sorry. It is the SEBI, that is Securities and Exchange Board of India, that used to regulate or supervise the investment advisors and the research analyst. So SEBI has said that the stock exchanges can supervise the investment advisors and research analysts, that is the stock exchanges can become the administration and supervisory bodies for the investment advisors and research analysts if they have some criteria met. Okay, so one of the criteria is that the minimum number of years of exchange of existence for the stock exchange should be at least 15 years. That is, the stock exchange should be at least existing for 15 years, then it can become an administration and supervision authority. Now, which has become the first administrative and supervisory body of the research analyst and investment advisor is which stock exchange? Which stock exchange is the first? BSC, very good. It is the Bombay Stock Exchange. Okay. So, so what has happened, that it has been said that the stock exchanges can become the administration and supervisory bodies of research analysts and investment advisors. So minimum number of years of existence as recognized stock exchange should be 15 years. Minimum net worth should be at least 200 crores. Stock exchange having nationwide terminals. Investor grievance redressal mechanism should be there, and stock exchange should have the investor service centers in 20 cities. Then the stock exchange can become the administrative unit of the research analyst and investment advisors. Okay, so the first, so BSC has been recognized as the supervisory and the administrative body of the research analyst and investment advisors. Now try to answer this question. See, what has happened, that for the passive mutual funds, so there are some active mutual funds like the mutual fund, the investment manager or the managers, they are regularly seeing that which stock is doing good or which stock can earn us money. So there is a continuous research that is happening and continuous kind of buying and selling that is going on. That is active mutual fund. Then there is passive mutual fund, where the managers, they just select a index and the, let's say, Nifty 50. So that is top 50 companies as per the market capitalization in the NSE. So Nifty 50, top 50 companies. So the passive mutual fund has selected this index Nifty 50 as the index. So the passive mutual fund will follow the same companies that are in the Nifty 50. On the same companies, the investment will be made by the passive mutual fund. So they do not use their own brain. They just select one index, and on the basis of that index, they invest on the companies where the index is like the companies that are under the index. So on the same companies, the passive mutual fund will invest. Now it has been said that the passive mutual funds, for the passive mutual funds, they can invest like the sponsor. There is someone that has opened this passive mutual fund. So the sponsor of the passive mutual fund, so it has some group companies. Let's say Reliance Industry is the sponsor of the passive mutual fund, that is XYZ passive mutual fund. Now the Reliance Industries have group entities or group companies such as Jio Financial Services or Jio Financial, the Telecom, Reliance Telecom, Reliance Oil and such. So these are the group companies that are belonging to same group of the sponsor. So it has been said that the passive mutual fund can invest up to 25% only in the group companies of the sponsor. But for the index funds, and for the exchange traded funds, for equity oriented, only for the equity oriented exchange traded funds, the limit is not 35%, the limit is not 25%, it is 35%. Okay, so for the equity oriented exchange traded funds and for the index funds, they can make investment according to the weightage of the constituents in the underlying index, but are capped at 35% of the net asset value of the scheme in the sponsor group company. So index fund and equity oriented exchange traded funds, they can invest in their sponsor group company up to the limit of 35%. So this is the idea. Okay, so up to the limit of 35%. For all the other passive mutual funds, the limit is 25% of the net asset that they can invest in the sponsor group companies. But for the equity oriented exchange traded fund and the index funds, the limit is 35% that they can invest in the sponsor group companies. Okay, to ensure transparency, SEBI has defined the widely tracked, that which indexes you can use, that is those indexes with collective assets under management of rupees 20,000 and above, tracked by passive funds or serving as primary benchmark for active funds. So this is the basic idea. And the Association of Mutual Fund in India, it updates and publishes the list of the indexes which can be followed by the passive mutual funds, and this is released biannually on April 15th and October 15th. This you can read. Okay, next is Ministry of Corporate Affairs simplified the reporting process for businesses transferring unclaimed dividends and shares to the IPFA. So what happens that if you have unclaimed deposits, let's say you have unclaimed deposits in your saving account, in your current account, if you have unclaimed time deposits, like the maturity has finished and they are unclaimed for 10 years. So they go to Depositor Education and Awareness Fund of the Reserve Bank of India. If you have unclaimed shares, if the people have unclaimed shares, unclaimed dividends, unclaimed interest on the dividends, unclaimed profits and such, and these are unclaimed for 7 years, so they go to Investor Education and Awareness Fund. Okay, that is managed by the IPFA. Okay, so Ministry of Corporate Affairs simplified the reporting process for businesses transferring their unclaimed dividends, unclaimed shares to the IPFA, to the Investor Education and Protection Fund. So businesses are required to provide detailed reports. So businesses that are having the unclaimed shares and unclaimed dividends, unclaimed interest and such, these businesses have to send the unclaimed money to the IPFA, and the reporting requirements are there. So that has been simplified. Okay, now the shares that are unclaimed for 7 years, they are sent to the Investor Education Fund. Okay, so this is the idea. So this is the whole idea, that the procedure of sending the unclaimed funds to the IPFA, that has been made easier, and the form, like the new forms, will be processed through a portal under the straight through process for automatic approval. Now coming to the next question, that Reserve Bank of India has permitted banks to use the ratings from Brickwork Ratings. So Brickwork Rating is a credit rating agency that was banned, or we can say that was like there was some restrictions by SEBI on the credit rating agency, that was Brickwork Credit Rating Agency. Now recently the RBI has said, so at that time in 2022, around that time, so RBI said that you cannot use, the banks cannot use the rating that is given by Brickwork Rating. But RBI has recently said that the banks can use the ratings that is given by the Brickwork Rating Agency, Brickwork Credit Rating Agency. Now the banks can use the ratings for what? For the loans that the bank is giving, for the asset that the bank is giving, for calculating the risk weight. If a entity XYZ has more credit worthiness or higher rating is with the XYZ, there is a lower rating of ABC. So to the lower weighting, to the lower credit rating, there should be higher risk weight, because if you have a lower credit rating, that means you are more risky. If you have a higher credit rating, that means you are lesser risky. So for deciding the risk weight, that which loan has higher risk weight, which loans have lesser risk weight, for deciding your risk weight, you can take the credit from credit rating from the Brickwork Rating Agency. Okay, so that is the idea. But for the fresh loans that is being provided by the bank, that is not exceeding 250 crores, for that only the rating can be taken from the Brickwork Rating Agency. So 250 crores is the norm here. So it has been said that the banks are hereby permitted to use the ratings of the credit rating agency, that is the Brickwork Ratings India Private Limited, for risk weighing their claims, their loans for capital adequacy purpose, because the banks have to maintain the capital against the risk weighted asset. So risk weight has to be decided for the loans, that which loans have more risk, which loans has lesser risk. For the fresh rating mandates, that is for the fresh loans that is not exceeding 250 crores. For the fresh loans up to the limit of 250 crores, the rating can be taken from the Brickwork Rating Agency. And in respect to existing ratings that is provided by some other rating agency, and in the tenure of the loan, again and again the ratings are required. So the surveillance rating can be taken from the Brickwork without any limit. That is for the older loan. For the older loan, there is no limit for taking the rating from the Brickwork. There is no limit in that for the rating surveillance if the rating has already been taken from some other entity before. Okay. Now coming to the next question, that is Project Nexus has been conceptualized by the innovation hub of the Bank for International Settlement. This aims to connect the fast payment system of the different countries. Now India has joined, the Reserve Bank of India has joined the Project Nexus, that is conceptualized by the innovation hub of the Bank for International Settlement. Okay. So there is a Project Nexus that the RBI has recently joined. So this is conceptualized by the BIS, by the Bank of International Settlement Innovation Hub, that is a banker of the central bank, we can say. So this Project Nexus wants to connect the fast payment system, the immediate payment system like the UPI of India and such, in the multilateral manner for the retail payments, for the person to merchant, for the person to person payments. So Project Nexus, who are the founding members of this Project Nexus and who are the first mover countries? So Malaysia, Philippines, Singapore, Thailand and India. So these are the 4 ASEAN countries and India. So 4 ASEAN countries and India. So 1, 2, 3, 5 and 6. So these are the 4 ASEAN countries plus India. We have become the first mover countries or the founding members. So who is the observer country? Anyone can tell me who is the observer country? Very good. Indonesia is the observer country. Okay. So this is Project Nexus that wants to connect the fast payment system of different countries in a multilateral manner. Okay. Now coming to the next question, try to answer this question. Yes, it is going to be live by 2026. Okay. Very good, everyone. Now try to answer this question. Okay. See, there are regular Demat accounts that charge. There are the annual maintenance charge. So in the Demat accounts, you keep your securities in the dematerialized form. You have government securities, you have bonds, you have, sorry, not government securities, like you in the Demat account, you are keeping your bonds, you are keeping your securities in the Demat form, in the Demat account, in the dematerialized form. Okay. So for the Demat account, you have to pay some charges. Now there, for the small investors, these charges can be too much. So for them, there is the basic service Demat account, that is for the small investors, for the investors that are engaging less in the financial markets. For them, so there is the basic service Demat account that is providing basic services and at lesser cost. So the annual maintenance charge for BSDA will be nil for portfolio value up to 4 lakh. So that means if you have in your portfolio, if you have the amount up to 4 lakh, you will not have to pay any annual maintenance charges for your basic service Demat account. If you are having the portfolio value up to 4 lakh, that means you are having the securities up to 4 lakh rupees only. For portfolio values between 4 lakh and 10 lakh, the annual maintenance charges will be given 100 rupees only. So that is also fine, that if you have the securities up to the limit of 10 lakh worth, so that means you will have to only pay 100 rupees as annual maintenance charges. So BSDA will be converted into regular Demat account if the portfolio value, if the securities value exceeds 10 lakh rupees. Okay, because the BSDA, you can have the basic service Demat account. This is the account that you are having if you have the securities worth up to 10 lakh rupees in your account. So the BSDA will only be converted into a regular Demat account when you have securities of higher than 10 lakh rupees. Depository participant, that is the intermediary that is connecting the depositories in the country with the customers. So there are the depository participants, intermediaries, that is connecting depositories with the customers. They must review and convert all the eligible existing Demat accounts within 2 months. Okay, unless the customers themselves want to opt out. So that is the idea. So here the first and fourth statement are correct, but all the other statements are wrong. Second and third are wrong. First and fourth are correct. Yes, E is the answer here. So basically, the basic service Demat account, before the limit was 2 lakh rupees. That if you have the securities up to the value of 2 lakh rupees, then your account will be BSDA. Otherwise, it will be regular account. Now the limit has been raised to 10 lakh rupees. That means if you have securities up to 10 lakh rupees, you can have the BSDA account. Okay. Now all the eligible accounts will be converted within 2 months in the BSDA. But if you do not want to have a BSDA account, if you want to have a regular account, then you can request and your account will not be converted into BSDA. Okay. So till up to 4 lakh rupees of the securities you have to pay 0 annual maintenance charges. If you have the securities worth 4 lakh to 10 lakh, then 100 rupees as the annual maintenance charges. More than 10 lakh rupees, if you have the securities worth more than 10 lakh rupees, your account cannot be BSDA account. Okay. So the charges are like this. All like if you want some special services, for that you have to pay the charges as per the special services. Now coming to the next question, it has been said that before IPOs are released, before the initial public offering is released, let's say I am releasing a initial public offering of my company. Okay, so before releasing the IPO, I have to release a draft red herring prospectus. That is a prospectus that is telling about my financial condition, about the financial condition that I own, the promoter, and the like why I am raising the money, why I am releasing this IPO. So that is a draft red herring prospectus. Now it has been said by the SEBI that the draft red herring prospectus, with that there is a audio visual disclosure that should also happen. Starting July 1, 2024, this will be voluntary, and from October 1, 2024, this will be mandatory. So audio visual presentation should be in the form of Hindi and English. Must be prepared in Hindi and English. That is bilingual. So the audio visual disclosure should be in bilingual format in Hindi and English. Okay. Next is, so SARI 2.0 has been launched. So which of the following statement is correct or are correct regarding that? So that you have to tell me. So SARI 2.0 app includes financial calculators modules, correct. App features an investor grievance redressal mechanism, correct. It was launched in 2022. Okay. First SARI was launched in 2022. So first and second statement is correct. That's why A is the answer here. Okay, so this is the basic idea. Now coming to the next question. Try to read the question and tell the answer. So SEBI has formed a committee to review the ownership and economic structure of clearing corporations, okay, to ensure their resilience, independence, and neutrality. So the committee is chaired by Usha Thorat. Okay. So there is a committee that has been formed by SEBI for the clearing corporation. So that is Usha Thorat is the chairman of the committee. Okay. Coming to the next question, that it has been said that the market infrastructure institutions will be penalized. If they are lacking in their surveillance, or if there is surveillance lapses that is happening. Okay. Yes. So recently in June 2024, regarding the new SEBI framework for financial disincentives to penalize the market infrastructure institutions. Market infrastructure institutions are the stock exchanges, NSE, BSE and such. There is stock exchanges, there is the depositories, that is NSDL, CDSL, they are the depositories. There are the clearing corporations, CCIL and such. So stock exchanges have stock brokers as intermediaries, depositories have depository participants as intermediaries, clearing corporation has clearing members as intermediaries. So market infrastructure institutions are the entities that have some power, like the stock exchanges, depositories, clearing corporation. So they have the power. If they are doing any surveillance lapses, So they have to bear the burnt also, they have to bear the penalization also. So the framework is effective from July and includes the penalties for inadequate reporting, non-reporting, delayed implementation of SEBI's decision, because they are the market infrastructure institutions. They are handling the whole of the financial market. So they should not be doing any lapses. The penalty will be based on the annual turnover or annual revenue. So penalty will be on the basis of annual revenue. If stock exchange has more annual revenue, they will also have to pay higher penalty. In the previous financial year, so how much of the annual revenue you have in the previous financial year and the number of instances of surveillance lapses you have done. Penalty money will be deposited. Now we are talking about SEBI. So penalty money will be deposited not in the Depositor Education and Awareness Fund, but in the Investor Education and Protection Fund. So penalty money will be deposited in the Investor Education and Protection Fund within 15 days. Okay. So the second statement is wrong. The third statement is wrong. That's why the incorrect statements are only 2 and 3. Only 2 and 3. Okay. Yes. So the financial disincentives are on the basis of annual revenue as well as number of instances of the lapses that has happened, the surveillance lapses that has happened. Okay. And the penalty money will be deposited in the Investor Protection and Education Fund by the market infrastructure institutions within 15 days. Now coming to the next news article or the next question, try to answer this question. So there are some investment companies and investment and holder companies. Okay, there are some investment companies and investment and holding companies. So what has happened, that their stocks or their shares are being traded very less. Very less trade is happening in investment companies or investment and holding companies shares. And their shares are being sold at more than 50, like at very less prices. So the SEBI has said that we are proposing a special call auction without any price bands to actually know that what is the actual price of these investment companies and investment and holding companies, because they are not being traded much in the stock exchanges and we are not able to recognize their value, because in the book value is quite high, but in the markets they are being sold at very less. So to recognize or to do the price discovery of the investment companies and investment and holding companies, we are going to have a special call auction. So the objective of the special call auction is to improve the price discovery for exchange listed investment companies and investment and holding companies. The proposal target for investment companies and investment and holding companies listed for at least, so the proposal is for which investment companies? For the newly entered, like this company has just entered 15 days before in the stock exchanges, just newly listed company. Should we start doing a special call auction for that? No. The proposal target the investment companies and investment and holding companies that are listed for at least 1 year, compliant with the listing norms, with the listing regulations, and their assets are being sold at 50% below. Like their assets are being sold. The 6-month volume weighted average price is 50% below the book value that they are showing. The auction price will be accepted only if at least 5 different buyers and sellers participate, continuing until a price is established. So first and second are correct, third is wrong. So correct statement is 1 and 2 only. Okay. Yes, 5 different buyers. So 5 different buyers should be entering, and this special call auction, it has no price bands. So the minimum, the maximum, whatever the value can go, and the price discovery will be better. Okay. Now coming to the next question. So there are only 70 questions. So here what has happened, that the InvITs, let's say there is a, see, InvIT is the infrastructure investment fund, okay, where the different investors are investing their money. Now this InvIT is established by some sponsor. So let's say there is a sponsor XYZ that is establishing the InvIT. Now there are different investors that are investing in this InvIT. Now different investors have their different idea about the project that they are going to invest. Now a sponsor is saying that this project is of more value, while the InvIT is saying that the sponsor is saying that this project has more value, while the InvIT is saying that there is less value on this project. So there is a valuation gap. So in the case of valuation gap, there are subordinate units that are released. Now subordinate units can only be sold to the sponsor. Subordinate units are cheaper units that is sold to the sponsor, but these cheaper units also have less rights. Okay, so these subordinate units, they do not carry any voting or distribution rights and can be reclassified. So why sponsor is buying this subordinate units with lesser or with no voting or distribution rights? Because the sponsor knows that if this project works well, because sponsor is assuming now that this project is of higher value, this project will work very well. So a sponsor knows that this project is going to work well, and if this project actually works well within like 3 years, like if the project is working well and the 3 years of period has passed, so this subordinate units that were sold at cheaper price to sponsor, this will be reclassified as ordinary units. So of course their price will increase. Okay, so when there is a valuation gap between the InvIT and sponsor, like the asset seller or the sponsor and the asset buyer, that is InvIT, if they have the valuation gap, so the subordinate units will be bought by the sponsor, so that if the project actually works well and when the 3 years is passed on, then the subordinate units can be classified into ordinary units automatically if the project works well and if the 3 years have been passed. Okay, the total number of subordinate units that can be sold should not exceed 10% of total ordinary units, correct, and should not exceed 10% of acquisition price, correct. Unit holder with at least 10% of the total outstanding units can nominate one director, correct. So first, third and fourth are correct, second one was wrong. Okay, okay, so second one is wrong. Because it should not be 2 years, it should be 3 years. So first, second and first is correct, third and fourth is correct, second is wrong. So answer is C, that is first, 3 and fourth. First, second is wrong, 3 and 4. So these are correct. So correct statements you have to find. Okay, so this is the whole idea, that to bridge the valuation gap, there are subordinate units that can only be sold to the sponsor or the associates of sponsor or the sponsor group, and these subordinate units will be reclassified if the minimum period of reclassification first of all is 3 years and if the performance benchmarks are being met. So investment manager must disclose the progress and in the the benchmark has been met. Okay, so this is the idea. As well as the unit holder with at least 10% of total outstanding units can nominate one director. Coming to the next question, kindly answer this question. Thank you so much, Jyotika, means a lot. Thank you so much. So SEBI has allowed up to 100% aggregate contribution. So in the foreign portfolio investment, the whole contribution, the 100% of contribution can be provided by the non-resident Indians, the overseas citizen of Indians, the overseas citizen of India, yes, the resident Indians, the resident individual Indians in the corpus of FPI. So in the corpus of FPI, the 100% of contribution can be by the NRIs, OCIs and the resident individual Indians. FPIs applying for registration must ensure that contribution of a single NRI, OCI or resident individual Indian should not be more than 25% of the, should be below the 25% of corpus. So this is the idea. So 100% of the investment can be by the overseas citizen of India, the non-resident Indian and the resident individuals, resident Indian individuals. So they can make 100% of contribution in the FPI, but a single NRI, single OCI, single resident Indian should not their contribution in the corpus should be below 25%. Okay, so this is the idea. At the time of registration, the FPIs have to declare their intent to have more than 50% or more than 50% of their corpus contributed by NRIs, OCIs and resident Indians. So when they are making their FPIs have to declare during the registration, the FPIs have to declare that they are intending to collect the money mostly from the 50% or more from the NRIs, from the OCIs and from the resident individual Indians. Okay, now coming to the next question. Recently, in June 2024, the Insolvency and Bankruptcy Board of India issued new guidelines to streamline the appointment of insolvency professionals. So, insolvency professionals are the ones that are looking after the whole of the insolvency and bankruptcy process. So, there is a complete insolvency and bankruptcy process that is under the Insolvency and Bankruptcy Code. So, if there is a debtor that is not returning the money, or let's say I am a debtor and I am saying that I have no means to return the money, sell my house, sell my land, whatever you want to sell, but I have no means to return the money, so I am bankrupt and you can sell my assets. Okay, or let's say a corporate, so I am the corporate debtor, or I am the debtor who is saying that I am bankrupt. Or let's say the creditors that have given the money, they are saying that this debtor is bankrupt and we want our money back. Okay, so a panel of insolvency professionals are the ones that overlook the whole of the process, whole of the insolvency and bankruptcy process, so that the debtor as well as the creditor, no one is harmed and no one is neglected in a way. Okay, this is the idea. So a panel of insolvency professionals will be established for the period from July to December 2024, and there is the two adjudicating authorities that we have, NCLT and DRT. So if you know about the adjudicating authorities, they are the specialized tribunals that is tasked with ensuring that the insolvency, resolution, liquidation, bankruptcy process is being performed as per the Insolvency and Bankruptcy Code. So these are the adjudicating authorities, that is the National Company Law Tribunal and the Debt Recovery Tribunal. Why do we have two? National Company Law Tribunal, this serves as the adjudicating authority, as the authority with jurisdiction over companies and other limited liability entities. The Debt Recovery Tribunal has the jurisdiction over the individuals and the partnership firms, excluding the limited liability partnerships. So there is NCLT and there is the DRT. NCLT is looking after the whole of the insolvency and bankruptcy process of the companies and the limited liability partnerships or the limited liability entities, and the DRT is looking after the insolvency and bankruptcy of individuals and such. Okay, so the insolvency professionals will work for NCLT and DRT both, in both the insolvency and bankruptcy process. Okay, to avoid the administrative delays, the IPs must have no pending disciplinary proceedings or convictions in the last 3 years, not 5, it is last 3 years. Priority for appointment will be given to those insolvency professionals based on how much of the volume of cases you have handled, how much of assignments you have handled, and IPs are expected to accept appointments without withdrawing consent unless permitted by NCLT. So IPs, once they have been selected, they have to accept the appointment. If there is any reason that NCLT, DRT or IBBI, if they are the ones that are saying that okay, if you do not want to accept, you can leave because of some personal problems or because of some major problem, so that can be allowed, but without the permission of the NCLT, DRT, IBBI, no IP can withdraw. Only with their permission they can withdraw. So this is also correct. So only the second one is wrong because it is not 5 years, it is 3 years. So 1 and 3 is correct. 1 and 3 is correct. So IBBI is actually the regulator of insolvency ecosystem. So IBBI has said that we are issuing the norms for the insolvency professionals, and the insolvency professionals will be shared. We are making a panel of insolvency professionals that will be shared in the NCLT and the DRT processes. Okay, and the IPs must not have the pending disciplinary proceedings or convictions in the last 3 years, and they have to accept the assignments, they have to accept their position until they are getting the exemption from NCLT, DRT or IBBI. So this is the idea. Okay, insolvency professionals, they are regulated and licensed professional that are responsible for managing and overseeing the corporate insolvency resolution process and the liquidation process or bankruptcy process. Okay, so this is the whole idea. Any confusion, anyone? Vasuli, correct. So next is see what happened that during the COVID-19, the EPFO, that is the Employees Provident Fund Organization, they provided a special condition. Okay, so during the COVID-19 pandemic, the EPF members, the Employees Provident Fund members, that whoever is having the money with the Employee Provident Fund. So during the COVID-19, as there were the medical emergencies that were coming up, as there were the medical requirements that were coming up, so EPF members were allowed to withdraw up to 3 months of basic wages and dearness allowance or 75% of the total amount that they have in their EPF account that they can withdraw on the pre-hand basis. That was allowed during the COVID-19. Now it has been withdrawn. That's it. Okay. So 75% is the answer here. So this is the idea. Okay. So during COVID-19 pandemic, the EPFO provided a non-refundable advance to EPF members. That is, you can withdraw up to 3 months basic wages and earnings allowance or 75% of the amount available in your account. The provision was applicable to exempted trust as well as the members. Okay, so this is the idea. Now coming to the last question for today, but I will take 2 more news articles. So be with me till the end of the session because you are getting something extra at the end of the session. Okay. The 2 news articles we are going to discuss further. So the Reserve Bank of India has launched an exclusive 2 hours window called finquery for fintechs to visit the dash of the RBI in Mumbai. Yes, fintech department. So it has been said that the fintechs, as they usually have they are the small entities, so they do not have much information regarding the RBI regulations, circulars and such. So it has been said that for the fintechs, there is a exclusive 2 hours window that will be provided on the last Wednesday of every month for the fintechs, and they can approach the fintech department of the RBI. Okay, so this is the idea. So the Reserve Bank of India has launched this window. This is an exclusive 2 hour window on last working Friday of every month for fintechs and to visit the fintech department in RBI to raise their queries and to seek the clarity and discuss the fintech related queries. Okay. Now this window will be open from 3 to 5 p.m. So this is the idea. Now a bank clinic to guide you on complaints. So bank clinic is an initiative by the All India Bank Employees Association to help the customers address their grievances amid rapid expansion. So what is happening, that there is rapid expansion that is happening of banks, of the retail banking and such. The technology is expanding as well. So the All India Bank Employees Association, they have launched a bank clinic where you can go and you can raise your queries, like how to approach a bank, how to raise complaint against bank, how to approach the RBI ombudsman. So this website, that is the bank clinic, is an initiative in the direction of financial literacy to resolve the queries of the people. Okay, it is not liable to take your complaints or to resolve your complaints because the bank that you are a customer with, that bank, if you have a complaint against that bank, you have to go to the bank. You have to go to the, if the bank is not hearing your complaints, you have to go to the RBI ombudsman. Okay, the bank clinic, it is just providing you some financial literacy, some educational ideas and such. So this is the basic idea of bank clinic. Now who has launched this? All India Bank Employees Association has launched this. Okay, now the next one is prudential treatment of bad and doubtful debt reserve by cooperative banks. So here, see, a big guideline has been provided, but the basic idea is that in terms of accounting standard, all the expenses which are recognized in a period should be included in the net profit and loss for the period. So what was happening, that some cooperative banks, what they were doing, that they have a profit and loss account. So this is the last news article. So some cooperative banks, they have a profit and loss account. Okay, now they are calculating their expenses, they are calculating their expenses and income, and after that they are calculating their net income. After calculating their net profits, after calculating their net profits and showing that okay, we have got the net profits of 500 crores, after calculating their net profits, they were deducting from this, they were deducting their provisions. They were deducting their reserves, like bad and doubtful debt reserves and such. So let's say the reserves are rupees 300 crores. So the net profits that is actually left is only 200 crore. The RBI said that this process is wrong. This should not be happening. You are showing your net profits higher while you have not taken out the provisions. You are taking out the provisions later on. Usually the expenses, like in the profit and loss account, you have to show your provisions as your expense. You have to show your reserves that you have to maintain as expenses. After you have taken out all the expenses from your income, then you should calculate the net profit. Because if you are showing a higher net profit, more shareholders will come, more people will be interested in your company. So you are trying to manipulate the market, you are trying to manipulate the people, right? So as you are aware, under the provisions of the respective state cooperative societies acts or otherwise, On prudential consideration, several cooperative banks have created bad and doubtful debt reserves. So bad and doubtful debt reserves have to be created. These are the provisions that have to be created, that if a loan is going into a bad loan, if a loan is becoming a bad loan, if a loan is not coming back, so you can use these reserves, you can use these provision to handle this distress kind of situation. So while in some cases the BDDR is created by recognizing an expense. So in some cases what was happening, that the BDDR was considered an expense and was deducted in the profit and loss account to take out the net profit. But in other cases what was happening, that in a period, what was happening, that in some cases the net profits were taken out, and after that the required provisions were deducted. Okay, so it has been said that this is not correct. This is not correct. In a period, if there is all the expenses recognized in a period should be included in the determination of net profit or loss. Consequently, not recognizing the required provisions for NPAs as an expense. So some of the entities, they were not recognizing the required provisions for NPAs as an expense. So the provisions, that is the bad and doubtful debt reserves or whatever provisions a bank is maintaining, the provisions have to be shown as expense, and after that the net profit should be calculated. So the RBI said that whatever you are doing is wrong as per the provisions, like with effect from financial year 2024-25, all the provisions whether accounted for under the BDDR head or whatever provisions you are maintaining shall be charged or as an expense to the PLN account, and when you have taken this out as an expense from your income, then whatever is left, that is your net profit, and you have to show it like this only. Okay, now the provisions or the reserves, they are known as below the line items. Below the line items in a profit and loss statement are the income or expense items that are not normally incurred in a company's day-to-day operations. So provisions or expenses, they are usually maintained in recognition of how much NPAs can happen, how much non-performing asset can happen. So this is not normally that is taken like every day I am keeping 100 rupees. No, the provisions and expenses are taken into total, like total loans that I have given, out of that how much NPAs can happen, and for that I am maintaining provisions. So provisions and reserves are below the line items. So previously banks may have created provisions required by appropriating from net profits, by taking the money out from the net profits rather than recognizing this as an expense. But now it should not happen, and whatever appropriation that you have done till now shall be made directly from the PLN account. Okay, such provision shall be permitted to be netted off from the GNPAs to arrive at NNPAs. Okay, and to the extent, so these are some of the guidelines that have been provided, but I have given you a basic idea, a basic overall idea that before accounting standards were not being followed properly, and now RBI has said that you have to follow this correctly. To the extent the balances in BDDR are not required as per applicable statute, the same shall be transferred. So if like you have from the GNPAs you have deducted the provisions, and after that if some amount is left, you have to transfer this to general reserves or balance in PLN account below the line. After passing the above entries, the balances in BDDR shall be reckoned as tier 1 capital, and from next time onwards, whenever you are calculating the BDDR or whenever you are calculating the provisions, you always have to take into account that they are expenses and they have to deduct it from your profit and loss account. Okay, so any confusion? This is it. Do tell me that how you did. I know that 100, like you must not have noted down how many mistakes you must have done, but do tell me if you liked the session and was it like understandable and were you able to give the answers correctly. If you have given more than 75%, of the questions you have given the answer correctly, so that means you are on the right track. Just further revision you have to do in the last few days, and 2-3 days are left, so do more revision, you will be good. Okay, to the extent the balances in BDDR are not required. So there are some provisions, some reserves that are not required to cover the NPAs. So as applicable, okay, the same. So whatever amount is left now, that can be transferred to general reserves or balance in PLN account below the line. Okay, After passing the above entries, when all of this has happened, the balances in BDDR, if it is still left, can be reckoned as tier 1 capital because this has become general reserves. So general reserves, the undistributed profits, they become the tier 1 capital, correct? So however, balance in BDDR shall not be reduced from gross NPAs to arrive at net NPAs later on. So this is the basic idea. So till now, as at March 31st, 2025, the extent of whatever the BDDR is, an appropriation shall be made directly, and this amount, such provision shall be permitted to be netted off from GNPAs to arrive at NNPAs, but from further period, the balance in BDDR shall not be reduced from the gross. So whatever balance is left, the balance have to be sent to the general reserves to be reckoned as tier 1 capital. So balance in the BDDR shall not be reduced from the GNPAs. Okay, so this is the idea. Most welcome everyone. So in the comment section, do tell me if you like the session, and if you have any query, you can ask in the comment section. And if you have given more than 75% of the question answers correctly, so that means you are on the right track. And this is the time to revise. Do not go after new articles now. Just keep on revising everything. Okay. John, I think for now you have to focus on revision. So whatever has been discussed, whatever you have found till now, whatever you have studied till now, I don't think now going after a new topic will help you, rather than revising will help you. Okay. Okay. Thank you so much, Bhavna, means a lot. Thank you so much, everyone. I cannot provide the annotated PDF because right now it might seem that annotated PDF is good, but when it comes to in the PDF form now, then the whole annotation changes and there are like you will not be able to read anything. Okay, so that is not required. Thank you so much, Suparva. Thank you so much, Aditya, Priyanka, Vaibhav, Bhavna, Tanu. So do tell me in the comment section also that if you like the session, it really boosts the morale when you go through the live chat is not available later on, but when you go through the comments, it really boosts the morale of the faculties also. So if you like the session, do tell me in the comment section also. Okay. So this is it. I think that this is everything is done now. GA for 5 months. Procrastinator, see, I tried to bring whatever I could bring. For sure, I was not able to cover 200 news articles that is present. I tried to bring the most important 70 or 60 news articles that I could do in the 3-hour time period. Okay, the time period is also relevant and important, right? So in the 3-hour time period, I was only able to bring 60 news articles, 60 new topics, or 65, 70 new topics. So like I was not able to cover 200, 300 of the topics that is in your past 5 months for sure. Okay, so I will not say that everything I have done, but yes, I have catered to the most important topics that needs to be catered to. See, last time RBI notifications, RBI reports, total RBI notification, RBI reports, total, there were 14 questions. From all the RBI reports, from all the RBI notifications, cumulatively, there were 14 questions. Okay, so this is it from my side. I hope you enjoyed the session, and do tell me, like, do leave your comments also in the comment section that if you like the session. So this is it from my side. I hope you enjoyed the session, and thank you so much for your well wishes regarding the Teachers Day. PDF, you will get the PDF tomorrow by 12 p.m. and in the Telegram channel you will get the PDF. Okay, so in the Telegram channel of EduTap you will get the PDF. I have to make 2 corrections also. So in the Telegram channel you will get the PDF by 12 p.m. tomorrow. Okay, thank you everyone. Thank you for joining the session. This is it from my side. Now we will meet on 6th September. Sorry, 6th September. We will meet for the Maha Marathon session. So this is it from